40 minutes.
And another reason why you think they go 25 basis points on September 18th. So, Aditya, I've got to ask you, what would change your mind in 40 minutes? What would make that 25 a 50?
So we've written about this. We think if the jobs report is really, really very weak, and I'm talking about, double digits on non-farm payrolls, maybe sub 50,000, and the unemployment rate going up, then I think they would seriously consider a 50 basis point rate cut. And they would basically have to tell us. I mean, I think the markets would price it in, and they'd have to confirm that or deny it when New York Fed President Williams and then Governor Waller speak later this morning. But it is important to remember that if they cut by 50, they have to understand that the markets are probably going to price more 50s down the line, right, in November and December, and they have to be ready for that. And for us, that is a pace of rate cuts that's consistent with a recession. So you cut 50 if you think there's a recession, but if you don't think there's a recession, you probably want to cut at a more gradual pace.
Priya Misra of JP Morgan was just on talking about how it's not really her take on what the market is pricing in. She doesn't see the bond market saying there's going to be a recession by pricing in more cuts, but just that the neutral rate is going to be that much lower and that the Fed is going to get there more aggressively now, just simply because you have seen some deterioration in labor markets. Why do you disagree with that?
So what I would say is, yes, it's possible the market is pricing down the neutral rate, but when the Fed is cutting to normalize or it's doing a mid-cycle adjustment, it cuts relatively gradually, right? 25 per meeting, 25 per quarter, something like that, because it doesn't want to convey a sense of panic to markets. Because when you do that, it's almost counterproductive. Then you're no longer supporting financial conditions, right? Because markets think, well, maybe the Fed knows something that we don't know. So 25 basis points if you're normalizing, but when you're cutting 50s, you're not just cutting to get back to neutral. You're probably cutting to get below neutral and actually accommodate the economy.
There's a sense that we've heard from an increasing number of guests that the labor market is actually quickly shifting away from being strong to something much less so. We were hearing just from Austin Goolsbee overnight in a Market Watch interview that actually he sees the data moving more than the Fed officials had expected. What are you saying? What are you seeing in there, the data that seems to reject that points to stability, to strength, to something that really kind of flies in the face of some of these more extreme rate cutting projections?
So we point to a couple of things. The first one is the resilience in consumer spending. So if you look at the last 4 or so months, spending has actually accelerated. It's probably running at around a 3% pace, which is above trend. That suggests, one, that the income that's being generated, regardless of what you're seeing in the official data, is sufficient. And two, that solid demand should continue to support decent job growth going forward. The other thing we would point to is we've had a lot of catch-up employment growth in a few sectors: leisure and hospitality, healthcare and private education, and government, right? So those sectors are slowing down. But if you look at the remaining job market, it's kind of just been running flat, right? There isn't clear sign of deterioration. And related to that, layoffs are also still very low. So that gives us hope that the labor market is still just normalizing rather than outright weakening.
Aditya, when you talk about the consumer spending, I think is healthy. What do you make of these CEOs that come out and say, though we do see consumers being choiceful or picky, that they don't still have the same kind of impulse that we did see a few months ago?
Right, so there's definitely going to be idiosyncratic companies and sectors that are more affected than others, right? In a trend-like economy, a good chunk of the economy is running below trend. And that's going to affect certain companies. But if you look at the aggregate data, which I think is the best that we can do, then things looked a little soft at the start of the year. But May, June, July were pretty good months, right? So overall, all we can say is spending's holding up. There's also this possibility that what you see in the stock market is not necessarily representative of overall consumer spending. A lot of consumer spending happens in service sectors that aren't well represented in stocks.
Aditya, before you go, I just wanted to get your thoughts on Governor Waller, who speaks ahead of the quiet period. The Fed speaks so far, we've touched on that. What are you looking for from the Fed officials going into the quiet period?
So we really like listening to Governor Waller. We think he's probably the second most important voice on the Fed. And part of that is because he's very forthcoming in answering questions, right? And he's very direct with telling you what his view is. So we would expect, if the markets are somewhere between 25 and 50, we would expect clear guidance from Waller. I think if you're close to 25 or 50, you've probably gotten a strong enough signal from the jobs report that you don't need Waller to take a strong stance. I mean, there is some tail risk that he'll have to jawbone the markets, but I don't think that's necessarily the most likely outcome.
It's an event to watch, that's for sure. Aditya, one of the best, one of the very best. Thank you for being with us, sir. Aditya Bava there of Bank of America Global Research, looking for 200K on payrolls in 35 minutes.
Talking about payback from the last report and then also just this ongoing resilience. One thing we haven't talked about, revisions to the prior month, revisions to the prior several months. What happens if they come in significant and actually downwardly revise some of those data points? These have been messy numbers, and they've been moving quite a bit.
You know, the other revisions we haven't talked much about, the Summary of Economic Projections gets an update September 18th. They've got unemployment year-end at 4%. Year-end 2025, they've got it at 4.2. Year-end 2026, they've got it at 4.1. Aren't we due a revision on that front as well?
Especially at a time where we're hearing from Fed officials that the data is moving a little bit more quickly than they previously expected. And oh yeah, guess what? We're already well through the unemployment rate.
Get a brand new dot plot as well, so lots to get excited about on September 18th.
Keep it down. Keep it down, John.
The next hour looks like this. Nadia Lovell of UBS, Michael Collins of Peach and Fixed Income, Jeff Rosenberg of BlackRock, and Torsten Slok of Apollo. Am I getting too excited?
Well, can I just say that I know people who make dot plot cupcakes.
Do they?
Pass them out, yeah. I remember that in the Bloomberg newsroom.
Someone did that at the newsroom?
Someone did dot plot cupcakes.
That's quite sad.
Yeah, I didn't really understand.
Do you want to name and shame now, or you want to tell me the commercial break?
We'll discuss in the commercial.
Okay. And then everyone gets the guess. From New York, this is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. The countdown is on. everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The unemployment rate moves up again. If you get a significant rise there, I think that's going to be a pretty worrying signal.
We're looking for north of 200K. Very importantly, a decline in the unemployment rate.
If we see a number closer to 100,000 this month, then we'll have to reassess our sort of view on the labor market.
It would take, we think, a pretty significant downside surprise to drive markets much lower.
There's no magic number here. It really is about the direction. And we should expect to see more softening in the labor market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
So this is it. This is the hour. The jobs report 30 minutes away. The estimates look like this: 165K, the median estimate in our survey for the headline payrolls print. For unemployment, looking for that to drop back from 4.3 to 4.2%. The jobs report just around the corner. The opening bell 90 minutes away, and the scores look like this in the equity market. A 3-day slide looks like it could become 4. We're down by 0.5% on the S&P 500. On the NASDAQ, down by 0.9. In the bond market, a 20 basis point move on a 2-year and a 10-year so far this week. The rally in fixed income, Lisa, continues.
And really, to me, this is the most pivotal jobs report of the year. And we don't always say that, but to me, this really marks the difference in terms of the tone, the tenor, and the speed of the Fed's rate-cutting cycle. People have said this. They've doubled down on it at a time where the time has come to start cutting. Now the question is to where and how quickly.
It won't determine whether they cut, but by how much.
Correct.
That's been the feeling for a while. What we need to gauge over the next 30 minutes, though, just get a clearer idea of how low that number needs to be to really cement this idea they go 50.
Well, what people are talking about is, what is the unemployment rate? How much does it come down or does it go up? Because that's also going to determine some of these other factors, like how big is the labor market? What is a good number? Things that we don't have a clear sense on. And then we aren't really talking about this, but we should. Downward or upward revisions to prior months of data, because we have seen a lot of messiness there. And if they upgrade last month's data to become better than it was, well, then we don't have the same kind of trend. But if they downgrade it, just watch. All of a sudden, you could get very different language from Chris Waller and a very different response from markets.
On the heels of that 800,000 downgrade we recently had, it feels like we have this spectrum of, we just heard from Aditya, 200,000 on the payrolls increase. That's 25. Andrew Hollenhorst, we heard from this morning and just published, he expects below consensus 125 new jobs, unemployment holding at 4.3 to be enough to go 50. It's that range on whether or not potentially it may push the Fed.
And it's not a big range. Let's be clear about that. What's the 4.3% unemployment, the 114 on jobs, signal or noise? Can you really point to factories in Michigan retooling, to weather issues down in Texas, as a reason to expect big payback in 27 minutes? The people looking for the 200K type numbers, that's what they're expecting.
To me, it seems like the question is also what the read-through is for the longer-term trajectory. The 200,000 crew believe in the soft landing. They believe that weakness that we've seen in the market is not something that is going to be more protracted and deeper and nonlinear. The people who see 125, the Andrew Hollenhorsts of the world, 125,000 and a greater chance of recession are those who see a quickly moving market to a different lower shift. And to me, that is the reason why suddenly you have Citigroup talking about this Fed not taking baby steps on the way up. Why should they take baby steps on the way down, especially if you see deterioration that continues to rear its head?
8:30 Eastern Time, 26 minutes away. Equities right now just off session lows on the S&P 500, still down by 0.5%. In the bond market, yields lower by 2 or 3 basis points, 369.86. The currency pair to watch, dollar yen. 4-day slide, 4 days of yen strength. How much more yen strength can we generate off this story in the U.S.?
Well, not just the U.S., also the other side. Actually, quite a bit. And here's the issue, and you've raised this before. Have we really blown out all the longs? Are we really done with that trade? Or could that be another disruption akin to what we saw August 2nd? We got the other labor market report at a time when we still saw a pretty big leveraged trade position.
Late start to the weekend for those of you in Japan. Good evening, Tokyo. Said this so many times, haven't we, over the last last few months. Coming up on this program, Nadia Lovell of UBS on why markets can continue to grind higher. Mike Collins of PGIM Fixed Income as traders see a growing chance of a jumbo September cut. And Torsten Slock of Apollo reacting to the jobs data. We begin with our top story. August payrolls out in just under 30 minutes' time. Data expected to determine the size of the Fed's next move. Nadia Lovell of UBS saying the soft landing remains on track. The labour market will cool gradually rather than contract. We continue to expect the Fed to start rate cutting in September. Base case, 100 basis points in 2024. Nadia's with us for more. Nadia, good morning to you.
Morning.
Last time we were with you, it was right before that payrolls print on August 2nd, 30 minutes before, and you were talking about the prospect of a soft landing. Has anything changed in your view with the data we've had in between those conversations?
I think largely, no, we wouldn't say anything has changed. We are still in that soft landing cap. There isn't any indication to us that the economy is decelerating at an accelerated pace. Of course, we're all watching payrolls, just given the weakness in July. But so far, weekly jobless claims has been well behaved. And what we're hearing from corporations, we're not really hearing any sort of broad-based slowdown. I mean, I know there was a consumer conference this week, and obviously you were at some. What I'm hearing from our consumer analysts is that the tone has been really constructive and seeing some positive data points coming out of consumer in August.
So if you expect growth to hold up and rates still to come down, why aren't you all in on small caps, all in on discretionary?
So a view on small cap has more to do with the sustainability of any sort of earnings growth in small cap. A lot has to go right, come together for the small cap trade to work. And quite frankly, some of it has already run ahead of itself. Small cap also needs the manufacturing part of the economy to cooperate. We haven't been seeing that in terms of the ISM manufacturing has continued to be weak. This is why we continue to lead into large cap because of a secular growth. Now, while I say that the economy isn't coming to a screeching halt, it is slowing down. 2% growth is still good, but small cap also needs that Fed to be a little bit more aggressive in terms of reducing rates for it to work.
I can just feel in the back of my head all the people calling you up. Do I just buy all the NVIDIA that I possibly can get? Is that essentially what you're saying?
Absolutely not. I mean, we have taken a more balanced approach in our sector position. And just given reality is, yes, there are parts of the economy that are still weak and feeling the pressure of restrictive monetary policy. So we do think that it is important to anchor in secular growth in tech, add some cyclical in financials, and then also a bit of a defensive exposure in utility. So right now we're in this phase where you want to be a little bit more balanced because, yes, the data is a little bit murky.
I want to just go back to this idea where you expect the Federal Reserve to cut by 100 basis points this year, and yet you still see a soft landing. You still see the S&P 500 ending the year at 5,900, again, from where we are now. Can you square those two ideas, that the Fed could cut pretty aggressively, and yet that doesn't necessarily mean that they see real trouble?
Yes. So in terms of the 100 basis point cut that our economist has penciled in, we're all data dependent. A lot is going to depend on payroll. Where we sit today, we'll know in a few minutes, it does feel like it's probably more of a 25 basis points cut to start off in September. But we want to maintain that optionality because we know that the data can shift quickly. So that 100 basis points cut could be more 75 basis points cut. Now, in terms of what you're seeing from the corporate side, you are seeing corporations holding in. Q2 earnings beat expectations. You're not seeing much downward revision to the forward estimates. So that's why we think that this market can continue to rally. Now, that's not to say there won't be near-term volatility. Right now, investors are on edge. And so far, it's been a good year. So you could see some people continue to take profits. You need that clarity. So we think the next couple of months will be volatile. But once we get into third quarter earnings as well as into Q4, we think that this market will start to regain its footing.
Once you want to buy ahead of that, what do you like right now?
Right now, tech, we continue to like tech, as I noted earlier, but we do expect some volatility in tech. And so we have been encouraging investors and clients to get that shopping list ready. And what's on that shopping list is going to be quality. We would be leaning into those AI logic chip names and also some of the foundry names. We think that the AI story is still largely intact. CapEx continues to move higher. And I know that there are questions, of course, around return on investment capital, but you are seeing use cases come through. Speaking of NVIDIA, we did hear NVIDIA say 40% of its data center revenues over the last 12 months came from inferencing. That's actually tied to model usage and actually tied to return on investment capital. Walmart also talked about, using AI and, for their projects, and if they didn't, that would be 100 times more headcount that they would have needed. It will take time, but we're seeing evidence of it.
I guess one of the uncertainties, and we've seen people struggle with this all year, is just how much rate cuts are going to support further gains in equities. And you're saying that there is a possibility that it could be 75 basis points of rate cuts, but there's also a possibility of 150 basis points of rate cuts. Would that be bad for stocks?
Yes, we do think so near term. Now, because it would suggest that something is breaking or has broken and the Fed needs to accelerate. We want the rate cuts to be gradual. We want it to be a marathon, not a sprint. If we're in a sprint, the equity market will react to that because now it's concerns about what does that mean for corporate earnings and what does that mean for growth going forward. So I think, if you get between 75 and 100, that's probably more palatable to equities than if you get 150 basis points.
We know what you like. One of your least preferred sectors is real estate, but we have rate cuts happening basically around the block. On top of the fact that Washington, bipartisanship, we're seeing, talking about the housing market. What would it take for you to maybe like real estate?
I think what we need to see is that the estimates come down a bit more. Real estate has started to perform better, yes, and I think it has run ahead of itself in terms of anticipation of rate cuts. There are still some capacity issues within real estate that we think that will start to filter through the earnings. So we think that there's a bit more downside to earnings and, FFFO. In terms of the other areas that we also are a bit cautious on, materials. We know that that's very much tied to China, and the data is just not coming in. It's coming in weak, and then also we're not seeing any sort of real pickup in industrial gas volume. So those are the two areas that we're a little bit more cautious on.
The commodity market's been difficult, that's for sure. Nadia, thank you. It's good to see you. Nadia Lover there of UBS going into the jobs report. 20 minutes away. The estimate 165K. Neil Dutta of Renmac writes in. Here's a line from him. Whatever the number is, it's being overestimated. We've asked this question so many times over the last week. Should we just chop off 60 or 70K from whatever this number is at 8:30?
I mean, let's say it's 145. Does that mean it's 85? I mean, how much? And that's why we go to the downward revisions. How much will that matter? Almost just as much of prior months as the actual headline number that we get today.
Chairman Powell back in July poured cold water over some of these numbers as well, remember? That was before August, before the number. He was talking about some of these figures being overestimated. 165 revised down to what, 80? Is that what we're running with, 90?
Well, revised down 60,000. That was sort of the average. I will just say this. He knows something that we don't know.
Who, Chairman Powell?
Yeah.
What do you think of that, the signalling from this? That if they go 50, it's something to worry about. What do you make of that conversation?
It's so fascinating to me because I've heard both. I've heard that on one hand, if the Fed is aggressively or incredibly tight, restrictive, why shouldn't they go quickly? Why shouldn't they get down to a level that's more closer to neutral, just simply to adjust to where the economy is going? And then you have Drew Mattis writing in, going aggressively on the way up didn't turn out so well, so maybe baby steps or a sense of humility would be warranted. So you have both kind of coming out. Really, to me, one of the most interesting questions is, if they cut 50 basis points, is that negative for stocks?
I like the Conoscent thought exercise. Blank sheet of paper. You came in from Mars, and you asked yourself, what's the right interest rate for this economy, given where inflation is, given what the trended jobs is? Would you come up with 5.5%? Would you? I'm not so sure you would.
And if you came up with the more likely 4%, would you be okay with just saying, okay, well, why not just reset it there right now?
Jobs right now, we're looking for 165, the unemployment rate, looking for that to decline to 4.2% from 4.3. We'll settle all of this, maybe, at 8:30 Eastern time. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former Bank of Japan Governor Haruhiko Kuroda signaled that the BOJ has a lot more room to raise rates. He said that the nominal neutral rate could be less than 2%. After their most recent hike, the key rate sits at just 0.25%. Kuroda joins other ex-officials who've told Bloomberg that rate hikes could be faster than most expect. Dollar yen sits around 143. That is a lower level than the early August aftermath of the BOJ hike and July jobs report. ABC reporting that President Biden is set to sign an executive order today for federal grants that prioritize projects with organized labor. Biden will make the announcement at a union trading center in Ann Arbor, Michigan. The party and VP Harris's campaign have been trying to shore up union support. Along with labor agreements, the grants would prioritize projects with wage standards and benefits like access to childcare and apprentice programs. Bloomberg has learned that Intel is weighing a sale of a part of its majority stake in Mobileye. It's part of a major strategy overhaul to improve performance. Sources say Intel could offload some 88% of its holding in Mobileye on the public market or via a sale to a third party. Mobileye has a board meeting later this month in New York where Intel's plans will reportedly be considered. And that's your brief, John.
Danny, thank you. Back with Danny in about 30 minutes' time. Up next on the programme, we'll get you some morning calls, plus looking ahead to the payrolls report with Mike Collins of PGIM Fixed Income. That payrolls report, 15 minutes away.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley.
The jobs report, 8:30 Eastern Time. We're looking for 165K. That's the estimate in our survey here at Bloomberg. The unemployment rate, 4.2%. That's the estimate against last month's 4.3. Equities negative by 0.5% on the S&P 500. In the bond market, the rally continues. Yields lower by 2 basis points. The 10-year 370.42. Let's get you some morning calls. First up, UBS lowering its Broadcom price target to 170 and keeping a buy rating. The analyst saying overall revenue guidance fell short of expectations. That stock lower by more than 7% in the pre-market. Your second call from JP Morgan downgrading Supermicro to neutral. The analyst citing a delayed 10K filing after the company said it needed more time to assess its internal controls. This has been building now for the best part of a week. We're down by 2% in early trading. And finally, KeyBank lowering its price target on Verizon to 44 and keeping an overweight rating following the announcement of the Frontier Communications acquisition. That stock is positive by, let's call it, 0.25%. Elsewhere, the focus firmly on the August payrolls report just a few moments away. Bloomberg survey looking for 165K and unemployment to drop to 4.2%. Michael Collins of PGIM joins us now for more. Mike, always special to catch up with you on Payrolls Friday, so welcome back to the program and good morning. The focus for you and the team, what are you focused on at 8:30?
Yeah, obviously, this could be a real market-moving jobs number, Jonathan. I think if it prints based on those expectations you just showed on the screen, I would bet short rates actually back up a little bit. There's a lot of rate cuts priced in. In fact, right now, as of this morning, the funds rate that's priced in just 1 year from now is all the way down to 3%, right? So that's 230 plus basis points of rate cuts in 12 months. It almost feels like you need something more than what we're seeing, which is just a kind of a gradual slowdown in the economy, a gradual weakening of the labor market. But to get those kind of rate cuts, it feels like you need something worse than that. So, you know, a bigger number, obviously, the front end could back up a lot if you get a surprise on the upside because of all of these cuts priced in. If the number, prints below 100, I mean, I guess the front end rallies. I guess you can continue to see the curve bull steepening. But man, there's a lot of cuts already priced in, so it feels pretty full to us.
There's just a feeling though, Mike, whatever the number is, this bond market gets bought either way. There's just a feeling that that's the bias right now in fixed income. Do you sense the same thing?
That has been the bias, Jonathan, and rightfully so. I mean, the economy feels like it's weakening pretty quickly here. It's been kind of on a moderating slowdown, and it feels like maybe we're starting to hit this inflection point where demand is coming off harder. We had some big international trucking companies report really weak numbers this week, and that's really typically a good leading indicator for economic activity generally. The manufacturing sector broadly, Jonathan, feels like it's in a recession. So the jobs number, the labor market is usually the last thing to fall, right? We looked at data this morning historically. The recession happens when the job number turns negative, right? So the jobs number is not a leading indicator. It is a coincident or even slightly lagging indicator. So given all of that, and obviously inflation, we're not even talking about anymore, right? It feels like it's dead in its tracks and stuck at 2% here, maybe indefinitely, maybe even going lower. So the bond market has been rallying because of all of this data. But again, there's a lot of cuts. There are a lot of cuts priced in. If you get an upside surprise, you could get a big sell-off in the front end.
Mike, it's funny because you're making the argument for why all of these cuts actually make sense and why you should lean into it. It sort of goes to this feeling that maybe we're going back to the environment that we left, of basically the neutral rate being substantially below where we are currently, and why not get the Fed to move more quickly to get closer to that, just to avoid that kind of falling off a cliff moment. What's the argument against that, Mike? I mean, what kind of number would you have to see to get behind some of the cuts that you're seeing priced in and then some?
Yeah, I think if you see, like I said, if you see the number come in as expected, I wouldn't be surprised to see some of those rate cuts come out of the market. Right now, there's over 100 basis points of cuts priced in for this year. So more than just one 50 basis point cut. There's almost a 50% chance of a 50 in the September meeting. So again, pretty aggressive cuts. But that being said, Lisa, I mean, you're right. I mean, like I said when I was on your program last time, I think the funds rate should today probably be closer to 3.5% than 5.5%, right? So if the Fed could snap their fingers and get it down to 3.5%, they would probably love to do that, but obviously financial conditions would ease significantly. So they have to be careful. They're really cognizant of financial conditions. I'm looking at yields on the corporate bond market today. I mean, they were at 6.5% not that long ago. They're at, about 4 3/4 today. The high yield market was in the 9s. It's at, just over 7%. I mean, we're getting back to much more historically normal levels. And companies, as you've seen, are issuing like mad. You're seeing a pickup in M&A activity. So definitely, animal spirits are alive and well, and the Fed has to be careful about that.
So are you basically saying, if I'm extrapolating out perhaps a little bit too much, that you think if the Fed goes as aggressively as the market is pricing in, that you run the risk of reigniting inflation as a serious concern, and that actually overheating becomes once again in the forefront of our minds, even now with some of this economic data and those trucking companies reporting some disappointing earnings?
Yeah, it is difficult to see the economy kind of resurge, go higher again, right, to overheat, Lisa. And it's difficult for us to really see inflation start going back up again. But obviously, the Fed is really worried about that. I mean, there's a lot of reasons why inflation could be stickier, right? And you have all this geopolitical risk that seems to be getting worse, not better. And obviously the political situation could spur more economic activity and cause inflation to go higher, given tariffs, et cetera. There are labor shortages around the world. You have, energy problems, this energy transition and climate risk. So there's a lot of reasons to think that inflation could be stickier. And the Fed is really focused on that, right? I mean, personally, it feels like inflation is moving in one direction and it's toward two. So, there's the markets feel pretty balanced here. I mean, the 10-year Treasury, where it is today, feels, fair value to maybe a little bit full, like I said. We would really look for opportunities to buy, add duration if rates back up from here. But the trend, as you said, has been one way so far.
Mike, I'm distracted. I've been down to ask for the last 5 minutes. Who gets the trophy? What's it for?
Hopefully me, Jonathan. This is our annual golf tournament. So I'm in third place, looking to take it home.
Good luck. Michael Collins,
Thank you.
featuring fixed income. Thank you, sir. The real stuff. You find out what they're really up to going into the weekend. It's like payrolls, yeah, super serious. Golf tournament, final round.
So how quickly does the tie come off? Sort of pull on.
And the golf shoes are on and they're ready to go.
Yeah, exactly.
Like 8:31 Eastern time.
Here down.
Out the door. Mike McKee's ready to go. He's in the studio. Mike, it's good to see you, sir.
Yeah.
Do you think Wall Street's overdoing it here?
Yes and no. I mean, it matters a lot for Wall Street because you're betting on, you're making asset bets on what you think is going to happen. But I think that I've pointed out to you earlier that the Fed isn't saying that they're data point dependent and this will make all their decision for them. And we were talking in the green room a little earlier about how this is going to matter for a few days, but then all of a sudden we're going to start talking about the SEP. What is their forecast for the future? And that's what will matter going into the Fed meeting. So it all kind of just goes by. I also pointed out that more Americans are worried about what Taylor Swift wore last night to the Chiefs game than the jobs report, I'll bet you.
Surveillance is very concerned, though, about the jobs report, and let's focus on that. And I would like to say that we're very focused on the statement of economic projections and how this labor market report fits into that. And that, I think, is the reason why it really matters.
And that jobs report drops next. 5 minutes away. Going into an equity futures decline on the S&P 500. Just a little bit softer. And the bid in bonds begins to fade. Yields are lower by not even a basis point at the front end of the curve. The jobs report up next. Mike McKee breaks it down, reacting. Jeff Rosenberg of BlackRock, Torsten Slock of Apollo from New York. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The jobs report, 25 seconds away. The scores look like this. Equity futures on the S&P 500 declining by 0.5%. On the NASDAQ 100 down by 0.8%. In the bond market, let's take a look at the yield curve. 2-year, 10-year, 30-year. Yields just a little bit lower, down a basis point on a 2-year. 3.72. On a 10-year, down 3. 369.67. The number we're looking for, 165 with the jobs number. Here's Mike McKee.
Well, here we go. Somewhere in between. That's going to make a dilemma for Wall Street. 142,000 jobs, but the unemployment rate does tick back down to 4.2%. Net revisions over the past 2 months down 86,000. So you take 86,000 away. Now we'll have to see what the breakdown of that is, because if you took 86,000 away from last month's very low number, you're not going to get very much. Average hourly earnings up 0.4, much stronger than the 0.2 of the month before of July, even higher than the 0.3 anticipated. And weekly hours rise to 34.3. Now, if you were looking for some sign that the economy was slowing, but we're not yet laying off people, you'd look for jobs to be, for hours to be cut back, and that is not what is happening at the moment. So I'll break down more of this, and John, you'll tell us what the markets think.
I was hoping you'd carry on for a little while so I could make sense of it, Mike. So initially off the back of this, the bond market got sold, and then it immediately got bought. At the front end of the yield curve, we're down by 8 basis points on a 2-year. As we always say, it's the first move. This is the second move. We'll see if it sticks. On a 10-year, we're down about 5 basis points. It's a break of 370. So that's the bond market picture. In response to that, in foreign exchange, dollar-yen dropping lower to about 142, so we're negative by 0.6%. Near session lows on that currency pair. The equity market turned positive initially at first look, and then dropped back again. On the S&P 500, we're down by 0.5. On the NASDAQ, we're about back to where we were, down by 0.9. At first look at these numbers, Lisa, I have to say, these numbers will not solve the debate in any way, shape, or form on Wall Street this morning.
Definitely won't solve the debate, but one aspect of these definitely speaks the loudest to me, and that's, and I'm biased, obviously, because this is what I thought going in, the downward revisions, and the fact that last month, which was already negative, was revised lower even to 89,000. To me, that is significant, and that is going to cause the Federal Reserve to have a more difficult decision than, say, if it were 100,000, but still you are seeing that being priced into markets. This is a Fed that's going to be headed lower on a more aggressive path.
So the bad news is last month was even worse than we thought it was. Mike McKee, the good news is that unemployment's dropped back from 4.3 to 4.2. Is this good or bad?
Yes. It depends on what you're looking at. I think this doesn't make a case one way or another, which would leave you with a default of 25 basis points. Now, job growth is slower. We've got to break that down and figure out exactly what's going on with that. But the unemployment rate falling back tells the Fed that we're not losing a lot of workers and the economy is not falling off a cliff.
What this does show me, though, is that these are messy numbers and that the path has been downward, and that has been the consistent path in terms of revisions. Mike, are revisions getting maybe a bigger look in this particular cycle just because it has been a noisier set of data post-pandemic?
Well, I suppose they're getting a bigger look, but you always get revisions, and they follow the trend. When the economy is slowing, revisions tend to be negative. When the economy is growing, they tend to be positive, and we're obviously in a slowing environment, so the revisions are going to be negative. That's not going to surprise anybody at the Federal Reserve, but basically, what they're looking at is how many people have lost their jobs and why. And that's the question that we've been trying to answer now. Remember last month we saw a huge number of people who had lost temporary jobs, or were on temporary layoff, and that number has dropped back tremendously. It was 1,062,000 in July, and now it's 872,000. So we're looking at a change of 190,000 lower, and that does suggest that the July numbers in terms of unemployment were a kind of a one-off.
In the commercial break, we were debating with Jeff Rosenberg of BlackRock what would be the most confusing labor market report today for the Federal Reserve and for market participants. And Jeff said something like, if you got a slightly softer jobs report, but unemployment actually dropped back from 4.3 to, say, 4.2. And Jeff, we got a mix. That's the mix we've got. So Jeff Rosenberg of BlackRock, Jeff, please make sense of this for us.
Yeah, tough to make sense of it. It's a bit of that mixture, but I think the headline reaction is to the slightly weaker payroll headline and the revisions, as Lisa was pointing out. So it's a little bit weaker on margin. You know, the bond market is very much behaving as if, you know, if we price it, they will cut. And so increasing the probability, or trying to push the probability to 50. I don't think this report is definitive on the 25 versus 50. I think it's going to be Waller.
What do you want from Governor Waller, Jeff, at 11 a.m. Eastern Time? What are you looking for? You think that's the final voice that sets up whether we go 25 or 50?
I think it is. I mean, I think it's set up on the calendar to give markets clarity on what the Fed's going to do. He will have had the information. He would have had a chance to talk to Powell. And so that you don't get a big market reaction, you know, not next Wednesday, but the 18th when the FOMC meets. So I think it is intended to, you know, provide a little bit of a steer to the market. So I think that's going to be, you know, as important as the number that just dropped, what we get in terms of the reaction. You know, and it's hard to say, you know, which way they go. I think, you know, the market is pushing for 50. You know, this number isn't, you know, particularly weak. You have the potential of the first print bias lower on the headline. Maybe that gets revised, you know, up. We're talking about revisions. This is a weirdness in the data where August tends to be weaker. You know, there's a slowing, and there's an argument, you know, on both sides. You know, if they do 50, does that, you know, kind of signal too much concern? They can talk around that. They can talk about 50 and talk about their confidence in the economy and kind of ease some of that concern. You know, so the market has been kind of right in the middle between the two. This morning, I think it's really just about that revisions and a little bit weaker relative to the expectations and consensus around 165, coming in a little bit below that.
As an investor, what's your response mechanism to a Fed that signals 50 basis points of a rate cut? Is it basically just extrapolating out about 150 basis points of cuts this year, and that essentially that's going to be questionable for risk assets? Or do you say this is supportive because this means that they're going to adjust quickly back to something that the market thinks is more neutral?
Yeah, you know, we had that debate yesterday. I think it's a tough one. You know, typically when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. This is a tricky period because you obviously have a lot of focus on the labor markets and the labor market deceleration as being the leading indicator. It's not really a leading indicator. It's kind of coincidence. Some measures are lagging. You know, the rest of the economy looks strong, but there's this fear that the Fed is behind the curve and that the rest of the slowdown is coming, and the rise in terms of kind of hard landing fears. And so 50 might, you know, kind of push people along that direction. So it's more negative rather than the Fed's kind of on the job. It's, the Fed's behind the curve. The 50 basis points validates our fear. And then you have all the other issues in terms of, you know, risks, high valuations, concentration in terms of valuation in the tech sector, all kind of leading to a lot of angst. And then even what we saw last month, you know, in terms of the outsized market reaction, positioning I'm talking about August 2nd and August 5th. So I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case. But yeah, it's a tough call either way.
Well, you were having the debate yesterday, Jeff, not just the market more broadly. What would your reaction be given the fact that the Fed doesn't have proprietary data that we don't see that points to a more conclusive signal about where this economy is headed?
Yeah, it's really about the Fed's shift. We saw it from Jackson Hole and Powell, and it's shifted this whole narrative focus and really market reaction focus onto the growth data away from the inflation data. And that shift means the Fed is worried now more about securing the benefits of their past policy intervention to secure the benefits of reducing inflation, and now focusing on securing the soft landing. So all of any signals around their sensitivity, any validation of that in terms of the data, makes people very much on edge that you're back not to the what Powell called the era of flouted rules, that you can't rely on these rules like the SOM rule, like labor market differentials, and other things that people point to when you have recession signals, that those may actually in this time be the right signal. And that kind of concern that you see in many commentary, many forecasts, gets more validated under a 50 basis point cut scenario. And I think that's the concern. That would be, the pushback. They can signal around that. They can use the language. They can use the press conference to manage that. But it's a tricky needle to thread.
Hey Jeff, this was great. Jeff Rosenberg of BlackRock. They can use the speeches through the next few hours. 8:45 Eastern Time. We'll hear from the New York Fed President John Williams later on this morning. Governor Waller at 11 a.m. There was a note from Neil Dutter of Renmac before this number dropped. He said, whatever the number is, it's being overestimated. When we talk about the bias in the market, you nailed it, Bramo. You talked about the revisions. That's what Neil's talking about.
This idea that probably you could see even more downward revisions, and something that Mike said, when you have a slowing economy or a slowing labor market, the revisions tend to be to the downside. If that's the case, doesn't this just edify that kind of sense that we're slowing? It sounded like Jeff Rosenberg didn't have a conclusion to the debate in terms of how they're going to respond.
There's no conclusion to this
There is no
debate.
conclusion, and that's, I think, the issue. People don't know how to deal with this, but you are seeing that sort of jitteriness follow through after this with yields markedly lower.
I can tell you what the bond market is doing, just to pick up on Lisa's comment with yields lower. We're down 9 basis points at the front end. Just moments ago, we took out the August 5th low on the 2-year, which was the low for the year. We dropped to about 363. We're at 364 right now at the front end of the curve. So that's a double-digit basis point move on twos. On the 10-year, we're down 5 basis points at 367. Equities are curious because once you see that picture, you start to think about the bad news is bad news scenario. Equities are doing okay for now. Equity futures, Lisa, down by 0.2%.
Which is essentially what a lot of people are hoping the Fed can actually navigate, which is a 50 basis point rate cut, which is now being basically priced in this month with that positive view forward that they're just adjusting rates more quickly to a neutral rate, not responding to an emergency situation.
Mike McKee still with us, going through these numbers. Mike, what jumps out for you?
Well, I'm going to front run John Williams and Chris Waller and say that they're going to do 25 based on the underlying numbers here, which are all pretty good from the Fed's point of view. Aggregate weekly hours up 0.3 after falling the prior month. That's used as a sort of proxy to help you figure out GDP. When you look at the unemployment rate, the level change in the labor force was up only 120,000. It was up 420,000 the month before. The number of unemployed went down by 48,000 in the household survey, while the number of employed went up 168,000. And we already mentioned hours worked. They went up. Not only did hours worked go up in general, but manufacturing hours worked went up and overtime hours worked went up. So it does appear that the economy is still fairly strong. And this sort of matches what we saw in the Beige Book. Companies aren't getting rid of workers, but they're not hiring them either. So if you're the Fed, there doesn't seem to be an emergency.
This Torsten Slock of Apollo got two benefits there. One, he got an extra 12 minutes to go over all of this, and two, Mike McKee set him up perfectly because, Torsten, you just sat there nodding. You agree, don't you?
100%. I mean, let's look at the numbers. Non-farm payrolls in August was better than in July. The unemployment rate in August was better than in July. Average hourly earnings higher than in July. And you look at average weekly hours, also better than in July. I mean, this report is better than in July. This economy is not slowing down in the way that markets are anticipating. We will not get 8 cuts over the next 12 months. Here, you should instead look at this report as this is really telling you that there is a soft landing.
So help me with this. In October, when we look back at this report and we get another revision, a downward revision, don't we have to reframe some of this conversation and just say everything keeps getting revised lower? This is Lisa's point over the last few days. This economy, this labour market is weaker than we initially thought it was.
But GDP in the second quarter was 3%. It was just revised up. Jobless claims continues to be good. Continuing claims was also good. If you look at the daily data for how many people go to restaurants, how many people fly on airplanes, the weekly data from Redbook on retail sales, if you look across the board on bankruptcies, if you look across the board on credit card spending, in the aggregate, the growth data is just not showing signs of a slowdown. It is true that the labor market is weakening, and yes, the JOLTS data has been a little bit, maybe more in balance, as the Fed would be saying, but this whole notion that the economy is slowing down rapidly, it is completely misguided.
What I thought was fascinating, I was speaking to a number of retail executives at this conference this week, and their biggest question was, what's going to happen with the consumer? They didn't know. They had zero visibility. Even though you are seeing some trends, some signs of robustness, some signs of weakness, they said ultimately it just depends on whether they have the money to spend. These labor market reports are raising a red flag for a lot of people, saying if they lose their jobs, they won't. How fragile is that sort of happiness that you're describing to a scenario like that?
Certainly, if we do have a rise in the unemployment rate, so that's not what happened, the unemployment rate went down, it would become a problem. But if you also, exactly as you know too well, look at what they did say, the retailers, during this earnings season. Target said no sign of a slowdown, Walmart, no sign of a slowdown, and also Costco, no sign of a slowdown. You saw Dollar General, some parts of consumers are under more distress, but broadly speaking, looking at retail sales, both the monthly, the weekly, and across the board on credit card data, there is just no sign of a sharp slowdown. So the bottom line in this discussion is that you only get a recession when you have a really big shock to the economy. And that makes sense, of course, with COVID, Lehman Brothers going under, of course, the bust of the IT bubble in 2000. But this is not an exogenous shock with something coming from the outside. This is all engineered by the Fed, trying to slow things down. And now the Fed is telling us that they're about to lower rates. So that's about to counter some of those negative things that have been weighing on the economy.
We get another headline from the Federal Reserve. Mike McKee from the New York Fed President, John Williams.
Yeah, John Williams is saying it is time now to join the party. He is not commenting in his prepared remarks about today's numbers. Of course, he wouldn't have had them ahead of time, but he does say it's time to cut rates. With the economy now in equipoise, which he titled his speech, that means in balance, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. So the guy who's vice chairman of the Open Market Committee is saying we're going to cut rates. He's not yet talking about by how much, but there is a Q&A, so we'll keep an eye on that.
And apparently owns a thesaurus too over at the New York Fed. Torsten Slok, what do you make of that, and what are you looking for from Governor Waller?
So I do think Waller will also give some more guidance in terms of what's going on, at least with the bigger economic picture, but I don't think that he will tell us much about whether this is 25 or 50. It requires probably a very important debate, given the spectrum of where FOMC members have been recently in their speeches. Some are clearly saying, some are even suggesting we should have much fewer cuts over the next several quarters, and others, of course, are suggesting that we should go much faster. So I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? I would say, and I would agree with Mike, that 25 is the right number, given that literally everything in this report was better than in July.
Would it be a policy error, though, to go by 50?
See, that opens up the debate about our star and how far do we need to go down. If our star and where we need to go to, and ultimately, so real rates plus inflation, if we only need to go to 4.5, we're not far away from that, so there's no rush to lower rates. If we do need to go all the way down to 2.5 or 3, then there is certainly more of a rush. But given the incoming data across the board is still good, why is there this rush to cut rates so dramatically, other than the R-star framework, which says that we got to get going?
Jackson Hole's speech was all about understanding the effect that Fed policy has on the overall economy. The conclusion was we still don't know. We don't have a sense of exactly how quickly it gets sort of transmitted and how much of the lag effects that we're starting to see. There is an argument if you cut rates more aggressively now, you can get ahead of some of the lag effects that we haven't yet even seen. Why don't you give credence to that?
Because there are three very important reasons why we did not get that slowdown that we all anticipated for so long throughout 2023. Remember, they started hiking rates in March of 2022. First of all, consumers and firms had locked in low interest rates. AI investment has been very strong, and fiscal policy has been a huge tailwind. All these things combined have been the key reason why the economy has not slowed down. And those things are actually still in place. A lot of people still, of course, have low interest rates in mortgages, in investment-grade credit, fixed rate, also very locked in for a long time. So that means that if you do start cutting rates, it's actually the transmission is also going to be weaker on the downside. It was weak when you were raising rates. It's also weak when you're cutting rates. So because of that, AI investment still strong, fiscal policy from CHIPS Act, Inflation Reduction Act, Infrastructure Act still strong. All this argues that the data will just continue to be steady over the next several quarters. There is no reason to expect this to be a hard landing. There is no exogenous shock similar to what we have seen during previous recessions.
Torsten, can we go back to the revision for a second? If you take off the 25,000 we took off last month and you do here for August, you'd get 117. Would you still feel this way if it printed 117?
Sure. Of course, the revisions are very important because we have seen some modest slowdown, but broadly speaking, the data was still better than what it was in July. So taken as the overall picture of, in particular with the unemployment rate, which is especially important when you put that into your Taylor rules and try to figure out what should the reaction function be from the Fed. And that's how all the regional Feds prepare the forecast. And if the unemployment rate goes down, it's hard to argue why they should be going 50. To go 50, you need some very, academic argument about our star, and you gotta get going with lowering rates very, very quickly. And the question is, with the incoming data being so strong, is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
Pause, because this is exactly where I wanted to finish with you. You're saying 550 is still not that restrictive for this economy?
So if where we're going, the terminal rate is 4.5, is 5.5 far away from 4.5? I know we, have been somewhat not quite brainwashed, but very distorted by a lot of FOMC members continuously saying we got to normalize rates, normalize rates, normalize rates. But let me ask you this, John. If we really had restrictive monetary policy, why have we, for 2.5 years and counting, still been getting very good economic data, including GDP in the second quarter at 3%?
The lags are just longer. They might say the lags are just long.
What should be the reason for that? The tailwinds from AI continue to be strong. The tailwinds from fiscal policy is still strong. We have locked in low interest rates for the consumer and for corporates. Where is this very significant transmission of monetary policy?
When we sit here and do this again a year from now, we'll do it before then, don't worry. In 12 months' time, where do you think rates are? They've got a 4 handle? They've still got a 5?
I think that they will be much higher than what the market is pricing at the moment because this is not a shock that is generating a recession. Why haven't we had a recession for now 36 months and counting? I mean, it is really the case that the economy and the economic data has just been much better than what literally any model would have predicted for the reasons that I just mentioned, namely locked in low interest rates, tailwinds from fiscal policy, and AI spending being completely independent of whatever the Fed is doing.
This is box office, and we should do it again next week. Torsten Slok,
I'm
thank
ready
you,
next
sir.
month.
Looking forward to it. Torsten Slok of Apollo, thank you very much. So the data's better than expected. If you look at the totality of the economic data in this labour market report, the yields are still lower because this Fed is still going to reduce interest rates. Equity is just starting to inflect a little bit higher. The one thing I'd like to know, if you want tomorrow's prices, I want the close at 4 p.m. I want to know if equities actually close positive on this report.
Because then it's basically saying to the Federal Reserve they can cut by 50 basis points and still signal that it's not because things are falling off a cliff. This from Priya Misra. We will stay stressed out. Now all eyes on the Fed. The faster they normalize, the less they will have to do, and they can keep the soft landing alive. Don't know if they're there yet.
Up next on the programme, we'll set you up for the week ahead, a big week ahead. The debate continues. Nothing's been settled around this table. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Everyone needs the weekend. Counting you down to the opening bell. 36 minutes away. The calendar looks like this. Today, Fed speak. Governor Waller, 11 a.m. Eastern Time. Ahead of the blackout period. This is really important stuff before the Fed goes quiet. Monday, new iPhone from Apple. Tuesday, Vice President Kamala Harris and former President Donald Trump facing off in their first debate. Wednesday, the Fed's next big data point, US CPI. On Thursday, we'll get PPI plus another round of jobless claims and an ECB rate decision. And on Friday, Mitch, consumer sentiment. A final word around the table. Bramo, first to you.
Does CPI matter at a time where the focus is so squarely focused right now on weakening in the labor market? To me, that's my real question, and whether the Fed really leans into 50 basis points.
Particularly after wages came in, just a little bit hotter than expected. AMH?
Bank of America saying after the most important NFP number, we have next week's U.S. presidential debate, next market catalyst. Will it really be a market catalyst? Do we actually get details from either of these candidates?
The last payrolls report going into that debate. Coming up on Monday, this is the lineup for you. Joe Quinlan of Maryland Bank of America Private Bank, Ed Yardeni of Yardeni Research, Sanal Desai of Franklin Templeton, Jim Bianco of Bianco Research. We said repeatedly it's a pivotal jobs report. It's decisive. It's settled absolutely nothing on Wall Street. The debate rages on.
And right now, this was not decisive for 25 or 50. It was not decisive for a neutral rate. To me, that will be an ongoing discussion. But right now, you see a labor economy that is downwardly weakening and that continues to do so. And to me, that needs to be really focused in terms of the balance of risks and how the Fed responds to it.
Those revisions appear to be a trend, which is why the New York Fed President John Williams has already come out this morning and said now is the time to reduce interest rates. Equity markets just about unchanged. The bond market is rallying. Yields are lower by 5 basis points. The 2-year is at 369. The 10-year is at 371. We have a normalizing yield curve. We'll leave that going into the weekend. From New York City, thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issue, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
A big miss on non-farm payrolls, but we're not seeing a big drop in futures. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, job jitters. U.S. hiring remained tepid in August, even as the unemployment rate ticked lower.
And now everyone is placing Fed bets. Billionaire John Paulson says the central bank has waited too long to cut rates.
We'll discuss all on that and more with our all-star lineup of guests, including acting Labor Secretary Julie Su, BlackRock's Rick Reeder, and PIMCO's Tiffany Wilding. Let's take a look at where markets are trading 30 minutes until those bells ring. We have a little bit of a gain on the S&P 500 pre-market. We had been lower, now peaking higher after that jobs report. It did miss, but maybe not enough to indicate that the economy is falling off a cliff. That could explain some of the action here. The NASDAQ 100 still lower, and the bond market, a little bit of a rally, Matt. The 10-year Treasury yield currently down about 3 basis points.
All right, the whisper number was lower than the 165 we expected in the survey. Here you can see non-farm payrolls growth. I will note that Mark Zandi told Tom Keene and Paul Sweeney on Bloomberg Surveillance just moments ago, you invariably see revisions higher from this August number because so many people don't report being on vacation in August.
Before we get back to the macro, we are going to talk about some pre-market movers on our radar. Broadcom shares falling, but not because of AI sales. It's actually because of the non-AI side of the business appears to be slowing in growth. Broadcom now down pre-market 6.2%. U.S. Steel, though, on the rise about 3.1%. Moving on news from its rival, Cleveland-Cliffs, whose CEO expressed interest in the company if the Nippon deal falls through. A big switch up in sentiment there. And sources say Intel is considering a sale of part of its 88% stake in Mobileye, and you have Mobileye down 3.5% pre-market, Matt.
All right, let's talk about U.S. hiring. Obviously, it's been the focus. We've been waiting for this jobs number all week long. It fell short in terms of the number we got for August. After downward revisions to the prior 2 months as well, we get more details with Michael McKee. He's our Chief International Economics and Policy Correspondent. So this is it. We waited all week for it, and really all month.
It's kind of a damp squib for people on trading desks because you're in the middle. You get good news on the unemployment rate, you get bad news or semi-bad news on job creation. Job creation, as you mentioned, just 142,000, and the revisions were important, minus 86,000. Last month, only 89,000 jobs created. The unemployment rate, though, falls to 4.2%, rounded out to 3 places, and you can see why, a significant drop from the prior month. Participation rate unchanged. Now, here's what happened with unemployment. The labor force did not expand as it has been. Household employment rose. The household survey unemployment fell. And so all of that combines to bring the unemployment rate down. Hours worked went up 34.3, which tells you that the economy is not falling off a cliff. Companies just aren't hiring. Same story we got in the Beige Book. We have had one Fed official, John Williams, the New York Fed president, vice president of the Open Market Committee, out this morning saying, with the economy now in equipoise, that was his word, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. He didn't say by how much. Maybe we'll get that from him as his comments go on, but now he is on board with a rate cut next week.
All right, Mike McKee, thank you for that, of course. You take a look at how markets are reacting, guys. Again, a little bit of a rally in the S&P 500. You could call it unchanged, though.
And big changes in expectations here for what people expect out of that rate cut. Potentially more cards now on that jumbo cut. And, of course, the 2-year real yield really plunging here, about 5 basis points this morning.
Just dropping away. The floor is gone from the 2-year yield.
Yeah, it certainly has. Well, we'll keep an eye on that and more as we welcome now our Bloomberg TV and radio audiences. To parse this report, I'm pleased to say we welcome Acting Labor Secretary Julie Su. And let's just go through some of the numbers here. I know you're well aware of what happened at 8:30, but the unemployment rate, it actually edged down to 4.2%. That was its first decline in 5 months. Payrolls only rose by 142,000 jobs. That leaves the 3-month average at the lowest since mid-2020. So jobs growth, and it is growth, it's weakening. Is that a concern for the administration 2 months away from the election?
Hi, it's good to be here with you. I would say that this is another job report that indicates that we are continuing to see stable growth. Jobs numbers are still up. The unemployment rate ticked down slightly. As you've already mentioned, labor force participation remains steady. Earnings are up. This is a continued sort of the, steady transition, to an economy in which we're continuing to see people come into labor market and find jobs. And, it's a transition to more stability.
And I know that you're not going to opine on what the Fed should do from here, but of course the concern is out there that we could see this weakening turn into a real deterioration if we don't see the Fed lower interest rates from here. The current policy rate, do you think that that's out of step with the economic reality in the labor market?
No, and you're right. We don't comment on what the Fed will do. But again, I think overall, this is another month of many months in which I've come here and we've talked about how we continue to see job growth, right? The numbers are still up. We're continuing to see growth in various industries. We see construction, healthcare, leisure and hospitality, right? These are all signs of an economy reaching a normal, steady, stable state. And we want to continue to create the investments that are leading to this kind of job creation. And the president will be traveling to Michigan later today to announce an executive order that is ensuring that we're not just counting the number of jobs, we're also making sure that these jobs are good jobs where families can get ahead, where people can make a steady income, where they can retire with dignity. And so these are all part of the economy that the president promised when he came to office and the economy that these numbers reflect.
Well, building on that, Julie, let's take a look at the specifics at the sector level, because you take a look at the manufacturing industry, it lost 24,000 jobs. The estimate had been for a reduction of 2,000 jobs. And actually, the last 3 of 4 reports, I believe, that sector has shed jobs. So what's the current view on why employment in manufacturing has been weakening?
So I would say cumulatively, again, the number of manufacturing jobs created since the Biden-Harris administration began is over 700,000 jobs. This is also part of the promise that we will make things in America again, from semiconductors to electric vehicle batteries. The idea is that American workers are the best in the world, and they can and should be making things. The investments that are going into communities are also, using American-made steel by American union workers and raw materials mined by American union workers. And so, the job growth that we have seen, which again was not promised, most people predicted that it would not happen the way that it has, is not happening by accident. It's happening because of real investments and a commitment to job growth. So when you look at the overall trends, manufacturing has gone up since the president came to office. Construction had significant growth over this last month, and that is also no accident.
And I also want to get your perspective, of course, on some snafus, if you want to call them that have happened at the Bureau of Labor Statistics when it comes to data releases, because there have been a lot of questions about fair access and distribution of economic data following, of course, the February super users incident. We had the early release of inflation data in May, and then last month there was that delay to the payroll revisions figures last month. What steps is the BLS explicitly taking to address those missteps?
So the BLS has addressed those head on. We obviously believe in transparent and timely release of data to everybody. That is why I come on. That is why we release the data each month the way that we do. And so the BLS has attacked those issues head on to ensure that they do not happen again. The fact that some of the information came out not in the way that we exactly would have liked in terms of their timing of release, certainly, though, doesn't take away from the fact that this data remains the gold standard for how we judge the health of our economy, how we look at job growth, the unemployment rate, and changes to industries when it comes to the labor market.
Well, Secretary, I'd love to get a little bit more detail on what that looks like, that head-on addressing. I mean, are you considering going back to lockups? Are you potentially firing people here or hiring more? What does that look like?
I mean, we've definitely put in place, to the extent that some of them were technical issues, right, addressing those issues. Again, we are absolutely committed to timely and uniform release of data. Each of these incidents were really, different, but we are taking a systematic look at how to make sure that they don't happen in the future.
And while I still have you, I asked about hiring specifically because I spoke to former Fed economist Claudia Sahm the day after that payroll revisions delay, and she made the point that the BLS is underfunded. And of course, our reporting and other news agencies have reported something similar. So I'll put that question to you. Does the BLS need a bigger budget?
I mean, certainly nobody wants to see all parts of the Department of Labor adequately funded for the important work that we do but I'll also say to that question about the Sahm rule and what it means, a lot of that is about looking at historical data to judge what is happening now. And I think what we've seen is that what's happened before isn't necessarily a good gauge for what is going on here today, right? The post-pandemic economic recovery, the historically low levels of unemployment for such a long period of time, and the investments that are being made that have really shaken up the job market in positive ways. And so overall, the many indicators are continuing to show that that the economy is growing and that the economy is strong. And either way, obviously, it's important for us to keep on reporting the facts as they come out.
Secretary, really appreciate you taking the time on what I know is a busy morning. Our big thanks, of course, to Acting Labor Secretary Julie Su. Meanwhile, let's turn this conversation back to the markets right now. Of course, the S&P 500 pretty much unchanged in pre-market trading. You take a look at the bond market right now. You have yields inching a little bit higher here. We have the perfect guest to unpack this all with, Rick Reeder. He is the CIO of Global Fixed Income over at BlackRock. He joins us now. Rick, great to see you again. You take a look at this market reaction. I know that you would have cut rates back in June, but you take a look at what the Fed is facing 2 weeks from today. Do you think that they should go 50?
Well, I've learned in my career to not invest based on what I would do. It's like you got to follow what they're going to do. And listen, I mean, I think they should go 50. Do I think they're going to go 50? I mean, we got an inflation report next week. I mean, that's going to be important. Listen, I think they're going to err on the side of doing 25s and stay down the fairway. I don't agree with it. I think the funds rate at 5 3/8, you've got inflation running. Like I said, we're going to get the data. But the last 3 months, you take the high frequency data, core CPI is running at under 2%, 1.6%. You strip out shelter, it's actually negative. And we know shelter's coming down. 5 3/8 is the wrong price. I think they should get there sooner. My sense is they're not in as much of a rush. And I don't think they learned that much today. You've got a slowly deteriorating labor market, but the slope of the line is just not that intense. And so, should they go 50? I think they will do, or I think they should. Will they? I don't know.
Rick,
I don't know.
To that end,
I don't know.
To that end, I'm curious about how you see the market pricing adjusting here. If you look at WIRP on the terminal, you have more than 118 basis points worth of cuts priced in through the end of the year. Is the market overcorrecting?
Listen, I think it's aggressive. Yeah, I think it's too much. That being said, I know we've talked about it before over the last couple of months. I like owning yields in the front to the belly of the curve, but I think what has happened is the front of the curve, exactly what you're pointing out, has moved to very aggressive levels. I think what people should do, and we talked about this the last couple of months, we're going to lose that. You've been able to sit in cash at 5 1/4 and just sit there. And by the way, the last couple of years, the trade has been sit in cash and NVIDIA, or cash and AI, or cash and tech stocks. That cash is coming down. And so I like the idea of, gosh, lock these yields in, hold the belly of the curve. I think people will be comfortable. You've seen the last couple of days, all of a sudden it's like, I got to get these yields for a longer period of time. That to me is the obvious trade. And that is the one, like, you can still get fixed income and build a portfolio with yields above 6% because the funds rate is 5 3/8. I think we're going to be a year from now. People are going to say, remember, we got to do that. That's where I think the trade is.
Yeah, I have a bond fund manager writing in, Rick, and he wants to know if the yield curve is really going to go positive and stay that way in the next 36 months. Can the long end stay below 4?
So I'm going to say it's a great question. So I'd say a couple of things. One, I think the curve will steepen. Like I said, I think the front end now is pricing in an awful lot. But I think the curve will steepen. I think that 5-year point is where you've still got some gearing to the Fed cutting rates. The long end of the curve, so if you take and you go back and say, okay, what should the long end of the yield of the long end of the yield curve be? Let's start the 10-year point. 10-year point, if you got nominal GDP running, let's say we're running 1.5, although we just printed 3. You got 1.5 nominal GDP, you got inflation, let's say it's 2-ish, although we're trending a little bit lower. Listen, I don't think that 10-year is that far off of, should we be 3.5 to 4 in the 10-year? I don't think we're going very far from there. Back end of the yield curve, I don't know why, you don't really need to own it. And so my view is, the long end, there's a pension bid, there's a life insurance bid. There's not that many long bonds in circulation after what the Fed owns and pensions own. So, I think people put on the steepener trade, realize there are not that many long bonds. I just think the long end of the curve is like, it's not, like in a portfolio construction today, A, it's not a hedge, and B, like, why do you own it? Just clip all the yields you need in the belly and carry on.
All right, Rick, we're going to hold you over. We want to talk a lot more with you. Rick Reeder of BlackRock is going to stay with us. I want to get a quick check on futures now. We've seen them in the green on the S&P, and we are up on futures 0.1%. So
that's so exciting.
Mike, you're more excited about that than Shonali is about the 2-year falling
the 2 basis points
below 365. NASDAQ futures down 0.1%. Russell futures down. Look, they're not moving that much, but as we get closer to the open, maybe we see a little bit more movement after that number that we've been waiting with such extremely bated breath for. This is Bloomberg.
number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
All right, quick check on futures here. We're really not seeing a lot of movement. For all the hype behind this non-farm payrolls number this morning, didn't deliver in terms of market reaction. S&P futures are basically unchanged. I mean, up 0.1%. NYMEX, I'm looking through assets across asset classes for movement. NYMEX crude, I see a little there, so oil up 0.5%. The dollar is doing a whole lot of nothing. The 2-year yield is down 4 basis points.
But 20 basis points on the week.
But 20 basis points on, no, you're right. I mean, it is a 370 handle, a 360 handle is a pretty big surprise there. We are back with Rick Reeder, CIO of Global Fixed Income at BlackRock. Rick, where could we see some real movement here? I mean, especially given the volatility that we are expecting in this period. You know, September is a horrible month, at least for stocks. We're getting close to an election. Where are you braced for some real movement?
So, Matt, I would say one thing that I think has been this weird conundrum. I know Katie and I talked about it last month, the last couple of months. Rate volatility is very high. And actually, when you look at, like you were saying, it's not really moving that much. I mean, by the way, it was a historically high rate vol pricing into this number. And then obviously that's melting away. Equity volatility has been really low in terms of what the markets are pricing into the options market. Listen, what should happen? So if you think about the multiple in the equity market today, you're pricing a PE of 24 and change with an economy that's slowing, and you've got an election with uncertain results. It's just been a conundrum why equity volatility is so low and rate volatility is high, given you've got a Fed that's pretty deliberate in what they're doing. I think that equity volatility has been a gift in how cheap it is. I think you'll see gyrate like you've seen. I think you'll see gyrating of the equity market. You know, you look at some of the tech names over the last few days. I know we have Broadcom today. Listen, I mean, to price PE ratio and technology in the mid to high 30s, you got to get earnings growth that is dramatic to get there. So I still think that the equity the volatility of the equity market is where we're going to see, and particularly in tech, is where you're going to see some movement here.
Well, Rick, that's really interesting. Just to crystallize that point, I was going to ask you how those two lines come back together, bond vol and equity vol. It sounds like you don't see bond vol necessarily calming down here. It would be a catch-up of equity volatility.
No, I think it's coming down. Rate vol's coming down a lot now this morning. I think, part of when you think about portfolio construction, things like agency mortgages that, people worry about volatility, I think rate vol's coming down. And I think rate vol will come down. But then, I think equity vol, it moves around sporadically. But then you get this period where people feel sanguine about where we're going. And, we were doing S&P call spreads when vol was under 9. And, now obviously we've moved up a little bit. That stuff doesn't make a lot of sense. So I think the idea is rate vol will come down. I think equity vol will be erratic, and then you buy it when it comes down.
All right, so there's the playbook there. I want to ask you about where you are on the curve. I know that you've been in the belly for a while. That's been the sweet spot when it comes to the Treasury curve. Are you still there? Are you thinking about extending duration now that we have a much clearer picture of where the Fed is going to go?
No, I mean, so we've been front to belly for a long time. And the one thing that I think is, letting some of the front go is, we still are in the front, but, it still carries pretty well. And if you think about where we're going to be, but, do I like letting some of our, this front end position we've had, should we let some of that go? Yeah, I think, and we have. Do you let some of that go? I think so. There is, people are building in a pernicious deceleration of the economy. I think the economy's slowing. I just don't think it's that dramatic. So a little bit of the front end go. But no, I still like, to me, if you can buy yield and, use the high yield market, use the securitization market, we talk about agency mortgages, Europe, where, you look at some of the data in the economy in Europe, particularly today, slowing, European rates. I still like that. And I still like buying these yielding assets and clipping coupon. Like if we can clip, so, go back, if the equity market, if return on equity is coming down, let's say in a slowing economy, return on equity is 8 to 10%. If I can buy fixed income and sit in yield at 6.5 or so, like that's pretty good. That is pretty good.
Rick, it's interesting. If you look at the movements in the bond market this week, this was really supposed to be the moment of the week after the payrolls data, and you did see a move, but really you saw bigger moves earlier in the week off the heels of other economic data that showed weakness. When you read the path forward and you're looking at the manufacturing data and the services data and the payrolls data, what is going to matter most to you to give you a picture of what this economy looks like and what's slowing down more than others?
That's a great question. So, by the way, I think surveys, like I like the hard data. The reason why today's number is so important, it's hard data. Like I think the surveys, people, say what they think they should do, but what they actually do is more important. So I love earnings reports. Listen, you've seen some some retailers with some pretty harsh numbers. I've talked a lot about low income. You saw that, it was $1. You saw a bunch of these companies. That, to me, is real data. And then, you got to focus on what's happening, the consumer, credit card charge-offs, auto loan delinquencies. That, to me, gives you a pretty good indication of, you got parts of the economy. We've talked about lower income that's struggling a bit. The other thing that I'm going to really focus on, CapEx and R&D spend. You have concern about global trade, what happens with tariffs. Are companies going to start pulling back? Because much of what's buoyed the economy, spend on R&D, spend on AI development, software, that's going to be really big. So how companies articulate, do you wait, do you pause a little bit to get more clarity? Right. That's going to be a big deal to watch.
Rick, we only have a minute left here, but I'm very curious about your thoughts about the political ramifications of what happens in the bond market. We spoke to John Paulson yesterday, who's an informal economic advisor to Donald Trump, who says he will lower interest rates, which of course we know he personally can't do. Only the Fed could do that. Yet Paulson believes we could end next year as low as 2.5%. What do you think of that call?
So I think rates should be lower, and there are a variety of reasons, and I think if some of the motivation for that is because we've got a debt burden in the country that's too high, I think it's right on path in terms of we need to get the rate down. I think, like I said, 5 3/8 funds rate's not the right level. We need to get the rate down. Do I think we're going to go that low? Listen, the data doesn't suggest we need to go that low. I think the terminal funds rate is higher than that. But listen, is the trend, particularly in the front, we talk about the belly of the yield curve, that we get rate lower? We actually have to get it lower because if you look at the debt service on the country, I think a year, 2 years hence, people are going to realize that debt service is a tough dynamic for the economy.
I realize it already. I talk about it every day.
There you go. Rick Reeder, it's always great to speak with you. Really appreciate you taking the time on this busy morning. That is Rick Reeder, of course, of BlackRock. Now, coming up, less than 4 minutes to the opening bell, we'll start the trading day with Greg Bottle of BNP Paribas. That's next. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We are moments away from the start of trading on this hallowed non-farm payrolls day. This is Bloomberg Open Interest. I'm Matt Miller. You can see that futures are really doing a whole lot of nothing, even after a miss on non-farm payrolls. Maybe that's because, you know, bad news wasn't bad enough to spur a 50 basis point rate cut. You can see the New York Stock Exchange here ringing the bell. Down on my over my right shoulder is the NASDAQ, and we're still over 100 points, 170 points basically away from an all-time high. Interesting note from Ned Davis out today saying that the volatility, the drops that we've seen here, we're still in the midst of a correction, but in a bull market. So let's see if any of that plays out today. Let's get over to Katie Greifeld right now. She's got a check on your major averages. Katie?
All right, like you said, a whole lot of nothing, but let me try to sell this. You take a look at the S&P 500 right now. It's up. We haven't seen that in a while. We know it's been an absolutely brutal start to September, to this trading week, but today, a little bit of relief on the S&P 500, up 0.1%. Not quite there yet when it comes to big tech. The NASDAQ 100 down about 0.1%. And small caps actually peeking into the green as well. The Russell 2000 currently up about 0.1%. Let's get over to some individual stocks that we're keeping an eye on. And up first, Broadcom. Shares down bigly after offering a disappointing sales forecast. Analysts noted that the company's non-AI portions of the business are growing more slowly than anticipated. That is not what traders wanted to hear. Shonali, shares currently down about 7%.
Bigly, I want to keep that word in this program, Katie. I'm also keeping an eye on U.S. Steel after the CEO of rival Cleveland-Cliffs said he was absolutely interested in bidding for the company's assets. You now have U.S. Steel up about 2.4%, and Cleveland-Cliffs roughly unchanged this morning. Remember, though, the Biden administration is preparing to block the $14 billion Nippon-U.S. Steel deal, and that Cleveland-Cliffs attitude is a real change in tone, Matt.
All right, Intel is considering options for its really large stake in a company that's gotten a lot smaller, Mobileye, the struggling automatic driving software startup, according to sources. Intel holds actually an 88% stake in Mobileye, which was a massive company, but now it has a market value of only about $10 billion. Let's get a closer look with Abigail Doolittle. Abby, what do you see?
Well, it is a really large stake. It's almost the entire company, as you were mentioning. Intel has an 88% stake in Mobileye. And earlier today in the pre-market, Intel had been higher on this news, the idea that they are considering lessening that stake. There's going to be a board meeting of Mobileye here in New York later this month where it will be discussed. Mobileye down 6.1% off the lows. It's been down somewhere between 2 to 3% to closer to 8% or more on the possibility possibility that Intel could offload this stake. And it's interesting because they offer software and hardware for self-driving automated systems. And because of the pandemic supply gluts, that has really hurt Mobileye. And so this is some of the facts that we were just talking about. In addition, it's interesting because they have a network and edge business, which has suffered big declines. Last year, they saw revenue for their network division fall by about a third. They're considering options there, and they're also considering a split of some of their product design and manufacturing. So Intel, which is down about 60% on the year, in a world of hurt, trying to produce and turn around Mobileye. You can see here the revenue on a year-over-year basis. The first quarter of this year down almost 50%, and then this third quarter estimate down 8.4%, 16%. Any way you take a look at the Shinelli, it is not good, and this helps to explain why Intel may be considering or is considering unloading some of that stake in Mobileye.
Abigail, we appreciate it. Thank you so very much. We're going to now bring in BNP Paribas U.S. Head of Equity and Derivative Strategy, Greg Battle. And you look at the S&P 500, and after 3 weeks of gains, you are seeing red on the screen for the S&P 500 this week. Tough way to start September. What does sentiment look like now going forward after we've seen a little bit more of a drawdown?
I think it's really mixed, and you see that looking at the options market relative to the spot market. So coming into today, we have the S&P just below all-time highs, but the VIX in the 20s. I think one of those two things has to give. Either we're in a more Goldilocks environment, and that VIX and volatility is going to mean revert, or you're going to see an S&P correction.
Yeah, we were basically at an all-time high on Friday, right? I mean, near as damn it to it. And we've been down every single day this week. Okay, there was no trading on Monday, but I think into the payrolls number, this market has been so bearish. Why do you think that is if we're getting set up for a rate cut?
So I think when you look at rate cuts historically, you tend to get one of two things. Either a preemptive rate cut that drives great returns for equities. So you could think of 1995, 1998, or 2019. Rate cuts followed by double-digit returns from equities. But you can see the converse where the Fed start cutting, and they're cutting for a reason, that things are slowing. And the start of Fed rate cutting cycles, think 2007 or 2020, have been around some of the deepest, most volatile drawdowns we've seen for equity markets. So really, it's less about...
Those were crazy times, dude. I mean, we're looking at 3% GDP growth and 4% unemployment. Inflation's a pretty mild 2.5%. Things look good.
In the rearview mirror.
Yeah.
So I think the important thing is the trajectory of the data, and we all know that the data is slowing. Yeah. And the question is it slowing in a benign fashion in which those Fed rate cuts will be welcome and it will help the equity market, or is it slowing in a way that it could accelerate? And I don't think the data that we saw today answers us one way or the other.
So what do you do with that? I mean, do you shift to a more defensive stance in your portfolios? When you look at the rear view, obviously tech has been the big winner, even with the last few weeks. Do you sell out of that? What are you doing here?
I think being more defensive is prudent at this time, but the way we do it is via the options market. So when we look towards what we have in the remaining kind of calendar year, next week we have the presidential debate. After that, we have the FOMC, the first rate cut of the cycle, with expiry. A couple of weeks later, earnings season kicks off. You see Broadcom getting stocks moving again this morning. And then you have the election itself. So there's a huge range of potential endpoints this year and a huge range of potential paths to get there. So owning optionality, we think, is the best trade into the back end of the year.
So we were having this debate this morning. We love to do this thing where each of us kind of take a side on something, and then we ask our guests to settle the score. How much does index rebalancing matter to this market heading into that rebalancing rather than coming out?
Especially considering this is a different rebalancing, right? Because Berkshire Hathaway, Buffett, they dumped a ton of Apple shares, which is a gigantic company. It's not the same as like triple witching, right?
Yeah.
I think index rebalancing can matter. It can matter for stocks. It's things that people can trade around. But where we end the year isn't going to be driven by index rebalancing. It's going to be driven by corporate earnings, the election, and then path to macro data.
So did we all win then? I feel like...
No, I feel like you came out on top. Katie said there's like a glitch for 15 minutes.
Here's the market. Is it a trader's market or an investor's one right now, given the volatility that we have?
I think it's a trading market. So you just look at the path of equities over the last 6 weeks, from all-time highs back down to 5,100, back up to touch all-time highs. So there's plenty of opportunities to be nimble and make money, and there's plenty of opportunities to be wrong.
Can I get your take on earnings? I mean, people tell us also that presidential elections, while we love to talk about it and it's sensationalist a lot of times, especially with one of these candidates, it doesn't really matter, right? Earnings is what really matters. And we had We were up, what, 11% on 12% on corporate earnings in the last quarter? Sales were up 5.5%. I mean, things look strong. Are they going to finish out the year that way?
Yeah, so valuations are elevated, so I think earnings need to be strong. The question that people will be looking at, again, is that kind of second derivative. It's similar to the macro data. Are things cooling slowly or are things cooling quickly? I would challenge you a little bit in terms of, do elections matter for stocks? If you go back to the 2016 election, small and mid caps, the Russell, IWM, it had 15 consecutive up days around the election. So there is definitely room for rotation, different relative winners and losers based on the outcome of the election.
So how are you playing that potential for rotation? I mean, is that something where you're going actually into the stocks, into the indexes, or are you also taking that options-based approach?
Yeah, so again, I think it's an options-based approach. The real challenge of trading the election now is there's an awful lot of water to come under the bridge in between now and the election date. So you could get the election call right and be very wrong in between. So I spoke just now about the reaction that Russell had to the 2016 election. I think it's probably the most election-sensitive ETF or major index that we would look at, but it's also very sensitive to the macro data. So if we had a further cooling of the macro data, weakness heading into the election, we think the Russell will be very sensitive to that, and we think it will be sensitive to the election outcome. So we think optionality on the Russell is probably one of the best ways to play directional trades, be them bullish or
Which
bearish.
president is better for the Russell? I mean, is this a situation where you want a president who feels the need to intervene in the rates picture, where somebody wants lower rates? John Paulson told Chanel yesterday 2.5%.
Or one that lowers the tax base for small businesses.
And taxes on realized gains.
Right.
If you have an environment where you have a presidential candidate talking about lowering corporate tax rates and focused on domestic policy, that's something that's going to be good for small and mid caps. We saw the reaction post the 2016 election where the best performing pocket of the market was the small and mid caps. So I think for us, that's the part of the equity market that would be most reactive to that outcome.
Okay, so on that note of lowering tax rates, you have former President Trump telling people that he will lower the corporate tax rate to 15% if you manufacture in America. But if you manufacture in America, does that raise your costs otherwise?
Potentially, but I think the knee-jerk reaction to the market is not necessarily going to be what's legislated. It's what's going to be talked about.
It's the direction, right?
We have that election at the start of November, and the price action through December and January is going to be based on that rhetoric there. So if we're leaning towards helping out domestic U.S. corporates, then something like the small and mid caps is a very domestically orientated index versus something like large cap tech, which is much more multinational and has much lower effective tax rates already.
All right, Greg, it's always great to see you. Really appreciate you taking the time out of a busy morning. Have a great weekend. That is Greg Bottle. He is BNP Paribas U.S. Head of Equity and Derivative Strategy. Now coming up, the hits keep on coming for Supermicro as it gets a downgrade from JP Morgan. Details next. This is Bloomberg.
Names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup.
This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
This is Bloomberg Open Interest. Quick check on some of the individual stocks trading just minutes after the open, 13 minutes in, 14 minutes into the session. Look at Mobileye there. Down another 9%, hitting a record low today. The report's out that Intel, considering a sale of some of its massive stake in Mobileye. Intel owns 88% of this company, but it's worth less now than $10 billion. So tough time to sell for a company that got in much higher. You're supposed to buy low and sell high. Broadcom down 10% after earnings that didn't miss. The forecast for $14 billion in sales was less than the $14.1 billion in sales that the street was looking for, but that's not, I wouldn't say a huge miss. Nonetheless, a concern about their non-AI business decimating the market cap, and then NVIDIA down 1.3%, a smaller drop, but a much bigger company, so will affect the indexes. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning, and first up, JP Morgan says that Supermicro is no longer a buy, downgrading the server company to neutral, slashing its price target nearly in half. The move comes, of course, in the wake of the company's delayed 10K filing. Usually that's not a good sign, and as such, the analyst recommends that investors remain on the sidelines until the company is back in compliance. You can see shares down 4.5%. Next up, Barclays says that Robinhood is no longer a sell, raising the stock to equal weight. The analyst says that the company has matured and sees potential sales catalysts from new products and regulation. Barclays also upgrading Coinbase for the same reasons. And finally, Frontier Communications no longer a sell, according to Wells Fargo. The firm is upgrading the telecom company to equal weight following its deal to be acquired by Verizon. The analyst says that the deal was a, quote, fitting end for Frontier, Shonali.
And coming up, the Fed should cut rates around 3%, maybe 2.5% by the end of next year. That's according to John Paulson. We're going to hear more from our interview with him next in our Wall Street Beat. Stick with us for that conversation next. This is Bloomberg.
Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. Let's take a look at the stock market about 18 minutes or so, 28 minutes into the U.S. trading day. You have the S&P 500 actually in the green right now. The NASDAQ 100 not exactly there. It's actually deepening losses because we have those losses in Broadcom, in Tesla, in NVIDIA. That is all weighing down on your big tech benchmark. Meanwhile, you take a look at the Russell 2000, your small caps up about 0.3%. It's your winner right now, Shonali, but, you know, the day is young.
The day is young, and it is long indeed. We're going to also talk now about the Federal Reserve, because expected to cut rates in a couple of weeks, of course, and some in the market think they've waited too long. John Paulson spoke to Bloomberg to tell us exactly that.
The immigration policy is a negative for our economy. If you look at New York City, we have hundreds of thousands of immigrants, which are costing the economy valuable resources that existing taxpayers are paying for. So we have to provide health care benefits, housing benefits, food benefits, and these workers aren't allowed to work. So I don't think the illegal immigration has been a benefit to American workers. It increased the supply of cheap labor, which held down wage growth for American citizens.
The wage growth has been part of the inflationary story, has it not?
Wage growth has been grown less than inflation. That's why real wages have declined.
I also want to talk about interest rates, because at the end of the day, there has been a lot of concern on Wall Street about what a Trump administration would mean when it comes to the Federal Reserve. There was, of course, that Wall Street Journal report a number of months ago that questioned whether the Federal Reserve would remain independent. And then we also had the former president commenting in an interview with Bloomberg as well, saying that the president can certainly be talking about interest rates because he has good instincts. That doesn't mean he's calling the shot, but it does mean he should have a right to talk about it like anyone else. Do you share that concern that he could potentially damage the reputation of the Federal Reserve as an independent organization?
No, I don't share that concern. I think it is important for the president and the White House and the Treasury Secretary to comment on economic policy, including interest rate policy. But ultimately, the decision is up to the Fed. But it's important for the Fed to hear other viewpoints and to make sure the Fed policy is in sync with overall fiscal policy.
To that end, what do you believe should happen with interest rate policy through the end of this year?
Well, when you look at inflation now is somewhere around 3%. Interest rates are 5%. So real interest rates are too high. So the Fed, I think, waited too long to bring interest rates down. So I think the likely course of action is going forward is the Fed will start to cut interest rates.
What should they be by the end of 2025?
It's difficult to predict, but my best guesstimate would be around 3%, perhaps 2.5%.
2.5% to 3%. That's where John Paulson thinks rates will end up by the end of the year. Now, time for Wall Street Beat, because former President Donald Trump made his bid to Wall Street and New York's business elite at the Economic Club of New York yesterday. And here is what he promised if he wins in November.
I am promising low taxes, low regulations, low energy costs, low interest rates, secure borders, low crime, and surging incomes for citizens of every race, religion, color, and creed.
Joining us for more on the candidates' economic plans is Bloomberg politics editor Laura Davison in Washington. And this was a really interesting moment right before that debate next week expected between former President Trump and Kamala Harris. But let's talk through first the reaction from Wall Street to that speech yesterday, because there were really mixed emotions, weren't there, Laura?
Yeah, there was really a sort of a difference in tone here from where the president has been. You know, he was going speaking in front of a bunch of business leaders, many of whom are not used to hearing Trump speak. So some are very surprised to hear sort of the proposals he has and sort of the way he talks about it without some of the specifics. But others, there were many Trump allies in the room, like John Paulson, like Scott Bessent, who said, "Look, you know, this is the plan we need. We need to move forward with very low interest rates, very low taxes." What Trump did not talk about specifically, though, is how he intends to achieve some of those things. The president, you know, cannot lower interest rates. That's the Fed's job. You know, lowering taxes. He needs Congress to do that. Energy prices, also something the president doesn't have direct control over. So those are the policy details that Wall Street is looking to see, kind of how he might go about doing that.
I mean, they all need Congress to play along, and it seems like he laid out a lot more in terms of proposals than the Harris-Walz campaign has laid out. I was also surprised, Laura, by such a warm reception, such a positive reaction by all that were in the hundreds of, like, the masters of the universe were there, and he got applause at, you know, many moments in between. So I thought it was pretty positive reaction.
Yeah, there were about 650 people in the room, which shows that people are not shying away from this event, that they are going, they want to make sure they're there, because there is a chance that a very strong chance that he is the next president of the United States. You know, Harris has been gaining on him in the polls, but this is a very, very tight race. And I think business leaders, as they're planning ahead, are looking, you know, that there could be a lot of different outcomes in this race, you know, both at the White House as well as the congressional level. And because 2025 will be such a big tax year in Washington, big swaths of Trump's tax cuts expire, which means that there will be an all-out fight, both from everything from, you know, capital gains to the corporate rate, that they want to make sure that they're prepared and positioned for what could happen.
And so set this up in terms of the debate that we're finally going to see next week. Of course, Kamala Harris and Donald Trump facing off. How much substance are we expecting when it comes to some of the economic policy proposals that we're talking about right now?
In short, not a lot. Neither campaign is expected to come to this debate, you know, to have new policy proposals that they're going to roll out during the debate. Instead, what both campaigns are doing is trying to make sure that they come out looking strong, that they land those zingers, that there are, you know, small little moments that can get shared on social media. This is not expected to get into the weeds of, you know, budget policy or any of that. This is more about overarching themes. And this is really sort of a difference from Biden to Harris. If Biden really wanted to campaign on the details, Harris is much more interested in campaigning more on a message and a vibe.
All right, Laura Davison, really appreciate your reporting as always. And of course, Bloomberg Television and Radio will have special coverage of ABC's presidential debate between Vice President Kamala Harris and former President Donald Trump from 8 p.m. to 11 p.m. Eastern on Tuesday, Matt.
All right, we will, well, most of us will be watching that.
Or asleep.
It's kind of late, right?
It is a little late.
For those of us who have to get in the office early.
We'll be paying attention. That is the catch-all
I'll
for
stay up and watch it.
Say you might watch the clips the
I
next
definitely
morning.
am glad I watched the last one.
You know, I'm glad we were both, well, you were there. I got locked out of the event yesterday.
There were things that caught a lot of us by surprise last time. Coming up in the next hour, Tiffany Wilding of PIMCO reacts to the jobs print. Then DraftKings CEO discusses the rise of sports betting as NFL football season begins. And Lending Club CEO prepares for interest rate cuts to impact his business. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming as well on YouTube. So head over to youtube.com and search Bloomberg Podcast. That's where you will find us. Alex Steele and me here with Jobs Day. Number came in a little bit later than expected. We had some negative revisions as well. People are wondering, is that good or not good, for this Federal Reserve? We'll see here. The Fed now. We will hear from the Fed September 18th. Coming up, Joni Biley, Chief Workforce Analyst and Employer Bridge. She'll join us as well to break down the numbers. Matt Michigan, Co-Chief Investment Strategist at John Hancock Investment Management. This is Fed data, this is jobs data. Does that change his outlook for the Fed and for the markets as well? Michael Casper, Bloomberg Intelligence U.S. equity strategist, will join us as well with his market call. So a lot coming up in reaction to the jobs number. Let's kick it off with the Bloomberg Business Flash. Mr. John Tucker.
All right, Paul and Alex, thanks very much. This report being brought to you by IBKR. With the Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. Major stock averages mixed right now, mixed a little change, and swaps traders boosting bets on a half-point Fed rate reduction this month after the latest data this morning. August marking another month of sluggish U.S. jobs growth. Payrolls rising by just 142,000 last month. Mark Zandi, the chief economist at Moody's Analytics, you talked to him earlier, Paul. He described this morning's jobs numbers as actually a pretty good report.
I'm all on board with the view that the Fed should be cutting rates and normalizing them very quickly. But today's report, I thought, pretty much down the strike zone. I mean, kind of right underlying job growth is 100, 150K. That's kind of where you want it. 4.2% unemployment. That's kind of where you want it.
Right now, the S&P 500, 15 points lower. That's down 0.3%, 5487. Dow Jones Industrial Average up 144 points. That's up 0.4%. The NASDAQ 100, 213 points lower. That is down 1.1%. Two-year yield, 373, pretty much unchanged. And the 10-year yield, it's higher than the two-year yield, 374. That's up a basis point. Regulatory filing showing Warren Buffett's Berkshire Hathaway continues to unload shares of Bank of America, selling $760 million of the stock since Tuesday. And quiz for you. Latest billionaire? Hint?
Me?
Hint?
No.
She used to be a member of the cast of Barney.
I know.
The big purple dinosaur. Vince Signorella's favorite show. Selena Gomez, worth $1.3 billion, according to the Bloomberg Billionaires Index. 32-year-old created her own
You go, girl.
beauty brand. So that's where it's coming from. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Now, I don't know her from Happy Friday. I don't know her from Barney, but I'm a huge fan of Only Murders in the Building.
Really?
Have you guys seen that?
No, I watched with my kids
so
when she was on
great.
Disney. There was like
Yeah.
some, I can't remember.
Do you guys even know what I'm talking about?
No.
Yeah, I didn't think so. Okay. Martin Short and Steve Martin and Selena Gomez. It's so good.
Really?
It's like everyone who's anyone is in this. You guys definitely need to watch it.
Yeah, okay.
This is a real recommendation. This
On
is
it.
not like a Deadpool recommendation. Okay. This is real. Just so we're all clear.
Very good.
All right. Well, okay. Jobs Day, we got through it.
Yep.
I gotta say, the market reaction is very not exciting.
Yeah,
I wondered if this was gonna happen yesterday. Okay, we get the number, and then nothing happens.
Yeah, I think the market's trying to figure out. We had Stuart Kaiser from Citi on just earlier, and he's saying, on their desk at Citi, they're like, well, that doesn't really help us very, very much. I mean, it's not like a really bad number that screams the Fed's got to move and there's problems with the economy. And it wasn't a better than expected number that said, hey, everything's copacetic.
Yeah.
So it's kind of in between.
And as Cameron Christ just said for his column in Macro Man, you can prove anything with statistics except the truth. Obviously, he's quoting British Prime Minister George Canning. All right, let's get more on this with Vincent Signorella, Bloomberg macro strategist, breaking down all of the market moves. So is this just like a really boring market reaction to what we hyped up as a really exciting labor report?
Well, I wouldn't call it boring. It's been really volatile. The market's been all over the place, both bonds and equities, back and forth all morning. S&P cash now sitting in the red, down 16. 10, 15 minutes ago, it was positive by about 10. So it's all over the place. I think what people are trying to digest is under the hood, the numbers just weren't as bad as they appeared, even considering the revision lower for the prior month. And you have to take into account the August and September numbers. Although this number was not affected by seasonals, September may be. It has a lot to do with back to school and things of that nature, and where Labor Day falls. And that definitely makes a mess out of the jobs report for this time of the year. So I would venture to guess the Fed, obviously knowing about this, isn't going to hit the panic button as the swap traders are pricing in, and more likely than not, we'll go with 25 this time and wait to see what the next number brings about.
Vince, we were just speaking on Bloomberg Surveillance with Stuart Kaiser over at Citi, and he says, probably for the next couple of months, this market's still going to be kind of driven by the macro, by the Fed and some of the macro data, as opposed to maybe fundamental earnings. Is that kind of how you're feeling, or what do you think's driving this market, or will be driving this market?
I think it's going to be a little of both. I don't think you can discount earnings completely, but I think that when you look at earnings, and especially some companies like Nvidia, and we saw a big disappointment with Broadcom last night. The tech stocks have been built up quite a bit, and when you have everybody leaning in one direction or sitting on one side of the boat, the chances are it doesn't usually play that way. So we're going to see a little bit of reversals where macro will affect things a little bit more. But I think you just can't discount earnings and say they're not going to have a factor. But the macro picture, especially the jobs data, and let's not forget inflation. It's not been beat. So when we see inflation numbers in a week or two, that may, that could easily, from the macro standpoint, flip things dramatically in these markets.
Okay, before we let you go, we already had John Williams speak, but at 11 a.m., this feels like the next main event. Christopher Waller will be speaking on the economy, and there's a Q&A, and the expectation is that he could parrot what Jay Powell and the Fed do on September 18th. What do you think he's going to say?
I think he's going to be a little bit more conservative than I think markets are pricing it. I don't see him showing a full-blown panic. It's not in the Fed's mantra to do this. And I say this all the time, markets react because they're traders, especially the swaps market. They're all over the place. These guys are economists. They don't think like traders. They're not going to, in my opinion anyway, hit the panic button. I think he'll tee up 25 basis points for sure. That seems to be where Powell is heading. I don't think he's going to jump the shark and go 50 basis points and get us all excited in that direction.
All right, Vince Signorello, thank you so much. We appreciate that. Vince Signorello, he's a Bloomberg macro strategist for Bloomberg News, joining us via Zoom. We had Mark Zandi on with Claudia Sahm, Mark Zandi from Moody's, Claudia Sahm, together jointly in an interview on surveillance, and they did not agree. Mark Zandi said, everything's okay, 4.2 unemployment, still adding jobs, blah, blah, blah. But Claudia says, no. If you look under the hood, the trends are not good. And the question is, are they problematic? So that's kind of a little bit of this, or just folks not agreeing on kind of what this data set means. Maybe our next guest can help out there. Joni Biley, she is the Chief Workforce Analyst at EmployBridge, joining us from Omaha, Nebraska via Zoom. Joni, you and EmployBridge, you know exactly how employers are feeling here. What did you make of this jobs print here today?
Well, this report definitely proves we have a weakening job market. We've been saying that certainly for some time. We feel it in the temporary help industry. Our industry, the staffing and recruiting, of temporary workers has really been on a decline for about 2 years. And those are always the jobs that go first. I think we've talked about that in the past. So it's pointing to, more weakness. Obviously, this report did not meet the expectations. I kind of thought we might see this just because, I'm constantly talking to employers of all sizes across the U.S., and there's a lot of uncertainty. There's economic uncertainty, and then there's also the election uncertainty. And so I think right now we're seeing a pause on hiring, and employers are just not adding to their payrolls due to that uncertainty.
So, Joni, that's such a great point. So they're not adding to payrolls. What do you think it's going to take for them to start laying off their payrolls?
Well, we are seeing some layoffs here and there. So that is, concerning. What I think will maybe reverse the trend, it's going to be a number of things. I hate to say it, but we might have to get past this election, regardless of who wins, until employers can say, all right, I have to find my path forward, and here's where I'm going to invest and hire. I think interest rate cuts will help, certainly. And, maybe we'll see a little bit of relief if we do see, an interest rate cut, which I think we're all in agreement that we're probably going to see one. The big question is, how large of a cut will they do? And there's going to be a lot of scrutiny, certainly around that, because that could signal, are we maybe in a worse economic picture than people had realized. But I do think an interest rate cut will definitely help because employers will then start to loosen up, those purse strings and start investing again in their businesses. And that can certainly lead to more hiring.
Joni, I like it in your notes here, something very interesting. Employers are focused on employee retention, but they're very cautious about hiring and adding to their current payrolls. How long have employers kind of been in that mode?
Yeah, no, that's a great question, because that pendulum definitely swings from one side to the other. But I would say that we've seen over the last year Employers very focused on retention strategies. Now, there's a few dynamics of what's happening. Certainly in the supply chain world, most of those workers are on site. In the professional and business services, we've seen employers trying to bring people back to the office, but they're balancing that with also trying to give them flexibility. So they're very focused on what types of benefit programs they can give to them. Of course, wages, need to stay competitive. Flexibility is certainly important, but creating a great work environment where people want to stay, where they enjoy the work that they're doing. That really has become a top priority. And we're also seeing that that's what workers really want. They want to enjoy the work, they want to enjoy the environment, and they do want to feel like their employers appreciate them and respect them. And so we definitely have seen a switch that employers are very focused on that retention strategy right now.
That feels like a young kid thing, but whatever. Joni, when you take a look across sectors, what sectors are sort of stronger and what are weaker, and sort of how do you foresee that playing out over the next 6 months as we get past the Fed cut, as we get past an election?
Yes, so certainly we've seen, healthcare continues to be the strongest sector that is adding jobs. And I think we will continue to see that. Certainly, as we look into 2025 and 2026, that sector will remain strong. There's a high demand. There's lots of, opportunity in many different roles in the healthcare sector. So that will continue to be strong. Construction, it was good to see that we added, over 30,000 jobs in the construction. Construction is a good sign that maybe we're starting to see some things pick up a bit. But again, on the other side, we're losing jobs in manufacturing. The professional and business service sector only had 8,000 jobs created. Again, I mentioned temporary help actually lost jobs for the month. Retail lost jobs. So overall, this really was a weak report. We're only seeing that job growth in healthcare and in government. And then it's, a little bit kind of trickled out through the other sectors. But healthcare will remain strong. I'm really looking for manufacturing to come back, but we probably won't see that until next year.
And another data point for the labor market earlier this week was the JOLTS report continuing to come down. How do you use the data, that JOLTS data? Is that important to you?
It is important, to watch the trends. We really want to see that number start to reverse and climb. Unfortunately, it's lagging. It's a lagging report. But when you look at 7.7 million open jobs, to me, that's concerning because month after month, we're seeing that number soften. What we need to see is that number start to increase. And that is going to be the first sign that employers are going to be hiring and adding to their payrolls, because the first thing they do is advertise those jobs. If they decide to hire, they're going to be posting those positions online. And that's what that report is truly measuring. So we want to see that employers are having more optimism about the job market, that they're going to invest and expand their payrolls and add. And I'll be looking closely to see, what next month reports for the JOLTS report. Hopefully it moves in the right direction, but right now it does seem, to be kind of status quo.
Before I let you go, what did you make of the wage number, and what are you hearing?
Yeah, so it's interesting on the wage number because the wage number is still showing that wages, are strong and certainly competitive. But that really has to do with the mix of jobs when it comes to that wage number. We are seeing a lot of the lower leveled skilled jobs, have been either outsourced or whether they've gone overseas, or maybe technology, automation, artificial intelligence has eliminated some of those jobs. So it has a lot to do with the mix of jobs. I can tell you employers are not raising wages right now. They are kind of steady. They're not decreasing wages, but but they are not in a situation where it's that competitive of a job market that they need to increase wages at this point. So it's a little misleading of an indicator when you look at it in the BLS report.
All right, Joni, thank you so much for joining us. Joni Biley, she's a Chief Workforce Analyst at Employee Bridge, joining us from Omaha, Nebraska via Zoom here. So I think in this jobs report, there's something for everybody.
For everyone.
You know,
I was going to say it's like a Rorschach test.
Yes, exactly.
You can make a bit of what you see.
We'll get one more, I guess, data point next week, CPI. So for the Fed, I mean, Ira Jersey from Bloomberg Intelligence just put out a note here and saying, you know, that'll have some meaning as well for the Fed in terms of inputs about whether they go 25 basis points or more.
So what I think is interesting is that if we get a read from where do we have the Fed speak coming? Waller. Woo, couldn't get that name. If we get a little bit more of a temperance there and maybe the market starts pricing in 25, I am wondering what the front end of the curve winds up doing. Do we need to kind of sell off a little bit because we've had such a massive run into the bond market, particularly in that front end, really flattening or disinverting that curve of the 210. So I'm kind of paying attention to that. All right, coming up, Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment, will be joining us. His take on the jobs market.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Labor market looks like it's softening, but the question, of course, now is it weak enough to warrant an aggressive rate cut from Fed officials? Non-farm payrolls rising by 142,000 following downward revisions in the prior 2 months. Right now, in stocks, 5 of the 11 major index groups in the S&P 500 are lower, being led lower by technology. S&P 500, 29 points lower. That's down 0.5%. We're at 5474 on the index. The Dow Jones Industrial Average is 5 points lower. The NASDAQ 100, 231 points lower. That is down 1.2%. Among some of the individual movers, Broadcom tumbling. They had a pretty disappointing sales forecast. Broadcom shares right now down just about 9%. And as far as yields, the 2-year yield lower, down 4 basis points. That's at 369. The 10-year 1 basis point lower. That's at 371. And we check the markets for you all day long right here on Bloomberg Radio. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm John Tucker. And that's your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, John Tucker. All right, let's get more on this market reaction here. Matt Miskin, Co-Chief Investment Strategist, John Hancock Investment Management, joins us now. Hey, Matt, if I just take a look at what's happening within the market and the reaction, oh, God, I hate to say it. Is this a Goldilocks move?
It looks a little bit like that, but the fact that the 10-year Treasury yield isn't backing down much, actually, to me, suggests it's not as favorable.
But it had a huge, it had a huge run.
It did. And mortgage rates are coming down on that. And then you're going to get borrowing costs coming down on that. And we had oil prices lower. And all these things eventually are going to be good for the consumer. But if economic growth is weakening, if you're not as confident about your job, you're not going to be as confident about spending. And right now there is a, September weakness that's always seasonal. So we're sitting here saying, is this seasonals? Or is this something more sinister? And for us, the economic data is weakening. We like defensive parts of the market. We like intermediate to longer term bonds. And we're going to sit here and wait for a better opportunity to look at risk assets.
What's defensive in your mind, Matt?
Good one.
Yeah, so good old utilities. Utilities are a part of the market that were left for... Not, no one wanted to touch them for much of the last 2 years. They were only 2% of the market, the lowest level or sector weight in history. They've been on a tear here, and we actually like long-lived assets. I mean, Alex, as you said, like this week, Treasury yields are meaningfully lower, and longer duration equities should be rallying on that. Utilities are, REITs are, even healthcare is getting a bit of a bid. But then you've got things like financials, which have done pretty well here. That's an odd mix. And tech, which used to be the long duration asset, is getting a hit. So it's not making a ton. It's not the dots are not connecting all at once here. It's 1 week. But the trend in terms of the macro data is what it is, and it looks like softening, and we want to grab some good defensive parts of the market while they're still here for us.
Yeah, and I don't want to make light of the fact that tech's down 1% and calling that Goldilocks, but just the idea that that sort of play versus, say, I'm looking at Dow Transport, it's only down, quote unquote, 0.3%. So I'm just wondering if it's more of a rotation within the market versus sort of a broad-based selling. Do you think that when we get Christopher Waller talking at 11, is that going to be an event risk for you right now?
It could be. Right now, I think the Fed, if they push back too hard and say, look, we're not going 50 basis points, we're not ready to cut. I think if they do that at this juncture, you're going to be upsetting the bond market. And there's few times in doing this. And since, nowadays we've got the forward guidance, and we've got, pricing in of how many cuts. You rewind 10, 15 years ago, people didn't focus on that as much. But now that it's 100% probability of a cut in September, if not more, because you're saying, hey, it could be 50 basis points. If the Fed says, no, we're not cutting, that is going to be bad news for everything. And so I think you need to hear the Fed speakers come out and say, yeah, we're going to cut. And if anything against that, I think is going to cause some volatility.
Hey, Matt, on the fixed income side, how much credit risk are you guys comfortable taking these days?
Not much at all, frankly. So we started the week at 300 basis point spread between junk bonds, high yield bonds, and treasury bonds. And to put that in perspective, last times that's happened, 2021 before spreads widened 2022, 2007 before 2008, 1999 before 2000, and 300 basis points is historically really tight spreads. And to us, that's just not a lot of value. We prefer, if you're going to go even in investment grade corporate bonds, more of a single A type of average portfolio credit rating. And then we like agency MBS. We like all those bonds or all those mortgages that people locked in low mortgages. I don't think there's any prepayment risk. People probably aren't going to be moving again.
True.
And it's good for their balance sheets. So, they're yielding about 5%, 4 to 5% right now. So we're just looking some high quality bonds, add that to the portfolio, lock in these yields while you got them, because that cash balance that everybody's loved so much, that money market interest rate, in our view, that's gone into 2025. Not completely gone, but it's going to be cut.
I'm waiting for it. We still hit another record high at the end of last week, according to the data that came out. So do you think that it matters if it's 25 or 50 in September? And or is it really how many cuts we're going to be getting? I mean, we're still pricing in something like almost 10 cuts through the end of next year.
Right. And, I think about it as like, getting lost in the forest. Wait, is it the forest and the trees, Alex?
Can't see the forest from the trees?
Right.
Yeah, something like that.
So the past couple cycles, on average, the Fed has cut from peak to trough 17 times. Now, that's 25 basis point cuts, but 17 times is how much the Fed usually cuts in a cutting cycle. So whether or not they cut one time or two times at the first cut, don't get lost in that. Don't overdo it. What you want to do is set up for where does the end of the Fed funds rate go? Where do we go on the 10-year yield? Our view, based on the last 3 cycles, the 10-year yield ends with a 2 handle, and the Fed funds rate ends with a 1 handle. If that is the world we're in, we're having a different conversation right now. We want to get, while these yields are where they are right now, I know it's been a quick move, but still, don't let the volatility, get you off course. Bonds are going to be likely recovering all that, in our view, majority, if not all, they lost in 2022. And we still got upside potential in the bond market.
All right, Matt, thanks so much for joining us. Really appreciate it. Matt Miskin, he's a co-chief investment strategist at John Hancock Investment Management, located up there in Boston. And if you are listening to us in Boston, our new home is now 92.9 FM in Boston. Good stuff there. So let's see, we're getting some moves here in the currencies a little bit. I'm looking at the Bloomberg Dollar Index, just a smidge higher on the Bloomberg Dollar Index. Pound sterling a little bit weaker, the euro a little bit weaker on the backs of some of this economic data we've got, including today's jobs number. Audrey Child-Freeman joins us. She's a team leader and chief FX strategist at Bloomberg Intelligence. Audrey, what are the currency markets telling you about some of the economic data we're seeing, including the jobs data today?
Well, the US dollar was already very much weaker getting into the non-farm payrolls. And I think in the end, from a currency perspective, for as long as we didn't get any major surprise one way or the other, it wasn't going to be a game changer for the outlook for the dollar, which we know by now has become a lot more negative with the start of the easing cycle looming. And most likely now, likely on September 18.
So to that point, how much more downside then is there to dollar yen in particular?
I think dollar yen is being driven lower by both by the U.S. side of the trade and the U.S. More dovish cyclical narrative, as well as the Japanese side of the trade. And I think in that respect, there's probably room for more downside. It's still very difficult to assess the extent to which, the unwind of the carry trade is complete. So seen some people saying it's almost complete. I think, time will tell on that. It's very complicated to assess. But I think that, the rate differential that's been driving dollar yen lower from 160 to 142 is going to continue into Q4. We're most likely going to see a rate hike from the BOJ and potentially even more next year. So I feel that, the dollar yen peak is probably, for me, in the G10 currency space, the most obvious one to expect to continue lower, with the main question being how fast does it go lower? And for me, I've been in the camp that we're probably going to see a slide as opposed to another slump.
So, Audrey, what currency out there offers the best value from your perspective, do you think?
Well, if you're dollar bear, and I think for now we still are dollar bearish, even though, I kind of feel that this narrative that I've been describing about, weakening U.S. economy, lower Fed rates, it's in the price. And I kind of feel at some point the risk would be that there's too much dovishness priced in the Fed, because the U.S. economy, let's be clear, is not really falling apart. It's just decelerating. Inflation is coming down, and that means that we can normalize interest rate in the U.S., and that's fine. But, in terms of which currency to play against, I said the yen is a good one. I also kind of like the Swiss franc, just because I feel that, euro-dollar upside at the moment is a very tricky one, because there's one element in the euro-dollar bullish story that I'm still waiting to unfold, and that's a pickup in economic activity. We're not seeing that happening in Europe. When that happens, I think there'll be more momentum to the upside on the euro. And until that happens, I think dollar Swiss downside may be more appealing. And the other advantage of the Swiss franc, I think, at the moment is the fact that, we've seen some episode recently of more hesitant markets, risk appetites. And the Swiss would do better if we were to see another phase of risk-off markets. So dollar Swiss downside is another very good and interesting pair, I think, as we contemplate the outlook into Q4.
In just about 30 seconds, what do we get from the ECB next week?
We get another cut, and I don't think that's going to be too damaging for the euro, but the euro badly needs an improvement in the economy. That's what we need for euro-dollar upside to go through 112 and 115.
All right. Thank you so much, Audrey. Really appreciate it. Audrey Child-Freeman joining us, team leader and chief FX strategist at Bloomberg Intelligence. Need a better economy. Like, how do you get that? You just take a look at Germany and then the news maybe that Volkswagen's going to close down some of its plants. Yep. Their industrial economy is just really suffering. How do you get the whole Eurozone to really start to outperform when Germany is really in the doldrums here? Yeah, and that kind of, a lot of it stems from they're just a big exporter, particularly to China. And if the Chinese economy is slowing, it has been slower than expected, and that impacts big export nations like Germany. And I saw that in that German reporting about the auto factories, they haven't closed auto factories since 1937. Yeah. So, I mean, that's not in their DNA to downsize. Yeah. There was an interesting report out by Nomura that talked about how it's really tourism that is keeping services up and keeping the euro economy afloat. So we'll see what then happens when you get out of the summer. Well, John Tucker and I are the only people I know that haven't been to Europe like the last year. So we're just... I haven't gone anywhere in a year and more.
Been out of New Jersey in like 20 years.
That's not true. You come to the city. Oh, well, that's... all right, coming up, we're going to talk to Michael Casper, Bloomberg Intelligence, U.S. equity strategist on the economy and the election.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages all going lower, seeing a surge in volatility as the stock averages kind of push between gains and losses, and now I said lower. The sluggish jobs data today bolstering speculation. Federal Reserve may offer a supersized half-point interest rate cut this month. Job growth rising less than forecast, 142,000. Claudia Saab, chief economist at New Century Advisors and author of the Saab Rule, reacted to today's jobs report.
So the increased unemployment rate is in a range where we have historically been in recessions, right? But that's a history, that's a past. We're not in a recession right now, but we do have a weakening labor market, right? So that's the important takeaway, but not a recession right now, but a risk.
Right now, the S&P 500, 58 points lower. That is down just over 1%. 54.44 on the index. The Dow Jones Industrial Average is down 196 points. That's down 0.5%, 40,559. The NASDAQ 100, 369 points lower. That is down close to 2%. Two-year yield, 7 basis points lower, 366. The 10-year, 4 basis points lower, 368. Oh, and Red Lobster exiting Chapter 11, a newly formed entity organized and controlled by Fortress Investment Group. Going to acquire the restaurant chain. And sorry, no more all-you-can-eat free shrimp.
I mean, that didn't work.
One person alone could drive the company into bankruptcy with that.
Yeah, for real. Also, you can eat a lot of shrimp. They don't take up a lot of room in your tummy.
We're both looking at Paul.
Mm-hmm.
Yeah.
I love shrimp.
I love me shrimp.
Yeah.
You crazy? Yeah, all right. Well, we look forward. Maybe a group trip to Red Lobster.
Yep.
I've been. Paul has not been.
Is there one nearby?
Times Square, baby.
Oh, really?
Everything there.
I think. I don't know. I might have made that up. All right. Looking at the market here, you're definitely seeing sort of the jobs market impact the equities, in particular the NASDAQ. Now we're really rolling over 2%. S&P is now down 1%. We're picking up some big steam to the downside here and taking a look at that bond market, seeing that safe haven buying come in. So Bloomberg Intelligence was out with a great report today that really caught my eye. It says the economy will matter more than the election for stocks in the fourth quarter. So we wanted to dive in on that a little bit. Michael Casper is Bloomberg Intelligence U.S. equity strategist, and he joins us now. Before we get to sort of the fourth quarter, can you talk me through why September normally is so bad for stocks?
Yeah, it's just a bit of seasonality typically. I mean, it's a month where we're pretty much outside of the normal reporting sequence, right? So July and August. Tons of reports coming through, especially for the S&P 500. September, not so much. So what ends up happening a lot of the time, especially these third months of the quarter, and September it seems to be in particular, is that stocks start to trade on more macro sentiment type things instead of fundamentals. So we had pretty good fundamentals rolling through in July and August, and that was carrying stocks through. Now we've kind of got to see where things go from here on the economy.
All right, talk to us about the economy. Why does that matter more than the election here in the fourth quarter?
Yeah, so the election, I mean, we've sliced and diced it a few different ways, right? Republican, Democrat terms, it kind of really just doesn't matter for stocks. The returns are very similar. And if you just bought the regimes that you liked, you're typically not doing as well as if you just bought and hold the S&P, over a long period of time. So we kind of don't like to say elections matter a lot for stocks. So with fundamentals really not rolling through right now and the reporting season going on, it's really on macro to drive things.
What do you think we're going to get?
So, I mean, this job market stuff it's a little bit weaker, but I wouldn't call it very weak at all. I mean, we're only.
Is it worth 1% down for the S&P?
I think that's more just kind of a little bit of indigestion, so to speak, of what's going on with the job market. So, if you get 50 basis points in, the next Fed meeting, it might actually spark a little bit more panic than a 25 basis point cut, I would say, right? But at the end of the day, it does allow the Fed significant leeway to do what they need to do, and that could drive stocks.
So what are some of the sectors that are screening well for you guys, given kind of where we think earnings are going to be?
Yeah, so the last scorecard we ran had healthcare and financials at the top. Financials is one that I was watching very intently this season, and they had a huge beat of EPS forecast. So I think it was about 3x what the number was expected to be at the beginning of the season. And you had very similar trends emerge in the small cap space, right? So small cap financials very dominated by regional financials, or regional banks, sorry. And those regional banks are starting to break out against the rest of the Russell 2000 in that same note that we put out yesterday. So very interesting sector.
Is that just straight up yield curve stuff?
Yeah, I think a lot of it has to do with the yield curve. But if you're thinking about the regional banks and the problems that they faced in 2023, a lot of it was, they had those unrealized losses from their bond portfolio. Now, if rates are coming down, that's not looking so bad. They had a lot of deposit flight. So if you think about your checking account, you're only getting 0.2% maybe on your checking account, and everybody moved their money out to money market funds where they're getting 4 or 5%. And if those trends kind of back away from the higher rates, right, the money market funds won't be yielding as much. Maybe some of the deposit flight stops. So kind of all the sentiment headwinds that we're building against financials and especially regional banks could be kind of abating here with easier rate policy.
Interesting. And how is sentiment in general? I mean, I'm looking at just the S&P right now. We're below that 50-day moving average. I'd like me some technicals, right? It's not that far to that 100-day. Yeah. How do you measure sentiment right now?
Yeah, sentiment, we have a market pulse index that we like to look at. It's pretty solidly in neutral, so that's kind of just status quo. Typically, we actually get more concerned when things get a little bit overheated, or as we call a manic condition. So not a lot going on that front. As you mentioned, some of the technicals getting a little bit weaker here for both the S&P 500 and the Russell 2000 remark, but certainly not that concerning yet, just kind of hovering around the 50-day moving average for both.
Consumer firms, could they benefit from AI? Because a lot of people are saying AI is going to make companies more profitable. Is that a theme for you guys?
So AI, not necessarily, but productivity gains for those consumer companies is definitely a theme that's been going on. For the amount of revenue that they pull in, the productivity per employee has been rising pretty significantly for both consumer discretionary and consumer staples companies. And it's definitely a trend that we're watching. They're generating more revenue per employee than they have been in the past, and that gap's narrowing between the consumer companies and the rest of the S&P 500.
So I know you said for a sector level, financials are screening really well for you guys, especially the regional ones. What about some of the safety trades like consumer staples and utilities and healthcare? In this environment, how have they been doing and how are they screening for you? Yeah,
healthcare, I mentioned the last time that we updated our sector rotation model, healthcare was firmly in the top. Staples and utilities more towards the middle, bottom. Staples has kind of an interesting dynamic, I'll note, in that it had a pretty solid run of EPS growth over the past, year and a half, when the S&P 500 was in a pretty solid EPS contraction or an EPS recession. Now, Staples obviously doesn't have those kind of lower comps to build up to it, so it's kind of getting left in the dust by the rest of the S&P 500. I think that's a bit concerning towards that sector story, but utilities, again, kind of towards the bottom. Though it is a rate sensitive, it'd be interesting to see how that plays out when rates do come down.
Small caps, I'm looking at the Russell 2000 off 1.3%. How are the small cappers looking for you?
Yes, so the Russell 2000 pretty much sitting right around what our fair value model would suggest is fair for the Russell 2000. Given consensus rate and macro expectations, the last time we updated that, it was sitting right around 2,200. We're a little bit south of that now, but we hit it a few weeks ago. So not a lot there unless macro reaccelerates or we get a significant downturn in rates. The downturn in rates could play out pretty heftily through valuations, right? So we're trading around 1.3 times sales right now on the Russell 2000. If you get a pretty dramatic shift in rates, you could trade north of 1.4 times sales, and that could be the upside for the Russell 2000.
All right. Michael, thanks a lot. Really appreciate it. Casper joining us, U.S. equity strategist for Bloomberg Intelligence. Talking about rates, we're looking at a 7 basis point move now on the 2-year to the downside. 366 is where we sit. 368 is where we sit on that 10-year. So still keeping that difference of about 2 basis points.
Right?
Well, they're still inverted.
Are they?
Yeah.
You got the 2-year 366, the 10-year 368.
So no, 2 basis points on the other side.
Yeah,
no, you're
so
right.
You're disinverted, right?
You're disinverted by 2 basis points.
Okay.
Yes.
That's better than saying not inverted.
Maybe that's true.
That's true.
Yeah.
Okay.
It's probably better to figure out what I'm actually looking at when I'm talking. All right, Dana Wollman will be joining us, Bloomberg Senior Technology Editor, on Broadcom and Intel. So Broadcom's AI results yesterday were really good. It's the other parts of their business that are struggling, and Intel, well, that's just all struggling. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, longest 4-day week out there. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in cloudy Midtown Manhattan. So the equity market really rolling over here. Big tech in particular getting hit. The NASDAQ is off over 2% below its 50 and 100-day moving average, making quick work of getting to that 200-day moving average as well. Not helping is what's happening in Broadcom. That stock down by over 10% on earnings that came out yesterday after the closing bell. Now, the money they made from AI and their forecast was really quite good. It was just everything else that seemed to disappoint investors, sort of waiting for that trough, despite the CEO saying, yeah, okay, we might have found the bottom in all of that. But nonetheless, the stock is off quite a bit. Dana Wollman is Bloomberg's senior technology editor. She joins us now. There's a lot to get through in tech, but I just wanted to hit on Broadcom. When you're looking at the stock reaction to the news, like, they delivered on AI. They made a boatload of money. They're going to keep making a boatload of money on AI. Do you think it's an overreaction from what you're hearing?
A little bit, and my background is not in equities. But to your point, you would think that the worst news imaginable would be that the company was not keeping up with expectations on AI. In fact, it beat expectations in all the parts of its business that are related to AI somehow. It's really its legacy businesses that were flagging in the forecast. But that, as you said, was enough to just send the stock down.
It's interesting. It seems like Broadcom is well positioned for this AI kind of phenomena here, because investors, as you know, are trying to figure out a way, how do I play AI? And really, do I just buy NVIDIA, or are there other ways to play it here? So, but tell us about Broadcom and its exposure to AI, maybe how it's positioned.
So I think Broadcom gets less attention, in part because I think it's in a highly technical field, a field that's already just very technical and sometimes difficult to explain to lay people. I think sometimes Broadcom's equipment is even more so, but it's everywhere. I mean, it's legacy businesses. Its chips were already in everything from automotive to smartphones, and its components are included in just AI setups as well. Yep. And it's not necessarily a one-for-one comp to what NVIDIA is producing, but just complementary components and piece of hardware that people might not know the names of or think of, but are necessary in these larger AI setups.
And also, what I was reading is that if a company winds up making their own AI chips in-house, they need Broadcom to do that. So there's that part of the business as well. Let's go to Intel, because that stock is also off over 3%. It's considering some options for its stake in its struggling automated driving system provider, Mobileye Global. Can you remind us what Mobileye Global actually does?
Mobileye makes an automated driving system. So
self-driving stuff?
Yes, autonomous vehicles. Yes. And Intel has had a stake. It actually sold part of its stake last year. I believe we reported a profit of netted around $1.5 billion from that. But it's looking to sell more of its stake. And as we report in the story, it's picking, if it's going forward with this, it's picking a not great time. Mobileye's stock has been down a lot. And so Intel would not exactly be recouping on its investment if it chose this moment. But as we reported more broadly, Intel is in a dire moment. It does seem to be considering some really desperate, severe measures to keep itself afloat.
Yeah, it's Intel. It's down 62% year to date, 52-week low, down 3.6% today. You've covered this tech industry for a long time, Dana. What's going on with Intel? Did they just miss, I guess, the technological evolution of the chip business, or is it management? What do you think's going on there?
Certainly, management doesn't help. I mean, it had that big CEO shakeup a few years ago. That was when Brian Krzanich stepped down. It took a while to replace him. And since Pat Gelsinger has been in the role, has bet big on the company's foundry business. And that is, in fact, dragging down the company's performance and seems to be, according to our reporting, something that the company's at least considering splitting off.
Well, okay, but that's confusing, right? Because their whole pitch was that, yeah, we're Intel, yay, but now we're going to make chips too and be a foundry for us and for also you, so you can come to us and we'll make our chips. So why has this gone so south?
At least for now, the foundry's biggest client seems to be Intel itself.
Gotcha.
Yes. So for whatever reason, that part of the business has not taken off. as expected. To the extent the company has brighter hopes, it does seem to be on the chip design side, less the manufacturing.
So, but weren't they a beneficiary, or are they not going to be a beneficiary of the U.S. government's investment in domestic chips?
I think they'd like to be if they had to delay that
Right.
plant, right? Yes. So that is something that our reporters are chasing, is not just the fate of the company, but the possible ramifications for the government's investment plans in strategic areas that, of course, include the chip industry.
Yep. And they're based in Santa Clara, California, where everybody who is anybody in the chip business is based in that Santa Clara, San Jose area there. University of Santa Clara is right there as well. Dana Woolman, thank you so much for joining us. Dana Woolman, Senior Technology Editor for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio, which we appreciate on a Friday. I mean, people coming in on a Friday.
He likes when people come in.
Come in on
Yeah.
a Friday. Special gold star. But you're right, the Intel stock is just getting crushed, and you know, it's just it's almost like a shadow of its former self here, with down 69%.
You'd like them to pull an IBM.
Right, you'd like to get an IBM and just kind of turn around. So, all right, Dana, thanks so much for joining us there. You bet. Looking at the markets, it is a continued sell-off here. We got the S&P 500 off about 1.3%. The NASDAQ really feeling it off about 2.08%. The NASDAQ 100 off 2.25%. So just kind of taking some risk off the table. WTI crude oil off at 1.6%. We're sitting right at $68 per barrel.
Right
so
now.
we'll keep an eye on that. Bitcoin off 2.5%, just under $55,000. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. I'm Alex Steele alongside Paul Sweeney. This is the second hour of Bloomberg Intelligence. We have a great lineup for you. We're going to break down all the market moves with Abigail Doolittle, plus Chris Smart is managing partner at Abarath Group. He's going to be joining us in the markets. Very negative reaction to the jobs report. Shruti Singh is back. She's Bloomberg News municipal finance reporter. It's Muni Friday. We'll be breaking that down as well. Plus, Lindsay Piazza is chief economist over at Stifel, and she will also talk to us through that jobs report as we look at a market that's trading pretty heavy and a lot of money coming into safe havens like bonds and the yen. We want to get more of a market update here, and for that we go to Business Flash with Charlie Pellet.
Very much, and here's what's going on. We are at the lows of the session right now. This update brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. Do want to begin with some headlines from Federal Reserve Governor Christopher Waller. He says it is important for the central bank to begin cutting rates this month amid rising risks of further weakening in the labor market. According to prepared remarks that he will be delivering this hour at the University of Notre Dame in Indiana, Waller said he is also open-minded about the potential for a bigger rate cut and would advocate for one if appropriate. Stocks lower right now. Again, lows of the morning with the S&P down 44, 54.59, a drop right now of 0.8%. The Dow is down 29, down by about 0.1%. NASDAQ, though, particularly hard hit. We have got NASDAQ down 282 points now, a drop of 1.6%. Our Abigail Doolittle will have a whole lot more on the markets coming up in just a moment. 10-year, 3.66% with the 2-year, 3.62. Spot gold down $1.89 the ounce to $25.14, down 0.1%. West Texas Intermediate crude continuing to slump this morning, 68.27 right now for a barrel of WTI, down by 1.3%. So where does this morning's employment data leave recession calls? Tiffany Wilding is managing director and economist at PIMCO, and she was interviewed this morning right here on Bloomberg Intelligence.
It's certainly not our base case that we'll run into a recession. And when we look at not only the labor market data that we got this morning, but a broader range of data, including retail sales and consumption, what we see is just an economy that is normalizing after a series of shocks, including the pandemic, but also a pretty big immigration shock that's been happening over the last few years.
Tiffany Wilding of PIMCO. Mobileye, as we have been reporting, lower after Bloomberg News reported that Intel is considering options for its stake in the automated driving systems provider. Mobileye right now trading lower by 6.7%. Intel down by 2.6%. Recapping just about the lows of the session for the U.S. equity market, with the S&P now trading lower by 49 points, down by about 0.9%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. I don't know, if I take a look at these Waller heads, this feels like this opens the door very much to a 50 basis point cut. I mean, saying things like he is open to front-loading cuts, that if appropriate, he will advocate for front-loading cuts.
Yeah, it sure does. I mean, I guess kind of the data we saw today from the jobs front, just enough for Mr. Waller to say, we need to be open to maybe being perhaps more aggressive than we initially thought. So we'll keep an eye on that.
Yeah, you're taking a look at the bond market reacting in kind. 2-year yield down by 11 basis points. I don't know if the market kind of expected this. Let's go to Abigail Doolittle. She is joining us, Bloomberg News markets reporter. Buy bonds, right? We're still buying the safe haven. You're looking at equities a teeny bit off their lows on this.
Yeah, we have a pretty decent sell-off. I would especially point us to the week. For the S&P 500 on the week, we're down nearly 4%, the worst week going back to March of 2022. The NASDAQ 100 down more, the worst week since November of 2022. But the big culprit, the stocks, those chip stocks, down 12%, the worst week since March of 2020. And today's selling pressure, really a piece of it. Now, I don't think it has so much to do with Fed Governor Waller. I think it has more to do with the jobs report influencing bonds that you were talking about, Alex, yield, and that in turn influencing the yen. We have the dollar-yen almost at the lows achieved in early August when we were at the height of the unwind of the yen carry trade, and it appears technically that we could be pretty close to something along those lines. It seemed that way for weeks. It's just you never know when these things are actually going to happen, and it appears that maybe this is happening right now, really taking the wind out of the sails of the too far, too fast. Broadcom, of course, their guidance was a little bit disappointing, down 10%. NVIDIA down 4% at 103. Now, 100, people are, that's something we have talked many times, how I thought it would go below 100 before, and it did, and then went back above, and I'm talking about 100. It actually, I would say 100 would be a gift for NVIDIA shareholders. It really looks technically, strictly technically, that it could go back to 70 or even 40. But what makes that so interesting is a year ago, it was at 40. So it basically is just a round trip of the massive AI craze rally that if that happens, it would just tell you investors got a little too excited.
Well, I'll tell you, I mean, if I would be, or I am very uncomfortable that if tech is not going to lead this market, or if tech is, what is? I mean, I can't, you tell me consumer, industrials, financial.
It's so interesting that you're saying this. So yesterday had my Bloomberg terminal in Italiano. Now it's on Francais, which I actually studied. So hopefully I'm going to be able to go in there and take a look at this quickly, basically. But I couldn't agree with you more because tech for the index, I'm just waiting for this to pull up in the Bloomberg terminal. So tech is, the better portion of the index along with the other two mega cap tech indexes, 30%, NASDAQ 100 about 50%. So the sentiment of the Apples, the Nvidias, the Googles, Microsofts selling off really is unlikely to outweigh any broadening that we saw in sectors elsewhere. That's one of those interesting things. For that to work so that the seesaw between let's just call it growth and value, it has to be pretty perfect for that to work, so that those massive weightings to those indexes don't weigh on the gains of other sectors. But we don't even know that other sectors necessarily would gain, because if you take a look at this jobs report, the reaction that stocks have had, bad news is bad news. It was a weak jobs report, and there's more and more people talking about how they think that there could be some sort of recession. Mike McGlone, your area, Alex, last year, saying that he was worried that the commodity index last year was down and that it signaled the likelihood of some sort of soft recession. We might be seeing that now. The idea that the Fed is going to cut and save that, I can't get my head around the Fed cutting right now. If you go out into the real world, inflation is nuts. The idea that they're going to add more fuel to that fire because of markets, it just doesn't make sense. At the end of the day, that they don't want to create a liquidity trap, so they want movement.
Fed Chair Waller saying that he sees more risk to employment than inflation. He feels more confident that the inflation is going to head down to 2%.
Yeah, I don't see that in my own everyday life. I'm fortunate to be, I guess I'm fortunate in some ways, but certainly, housing, I think it's doubled 50%. Cars are up 30%. I mean, affordability is a real issue for people who aren't making, for pretty much everybody, frankly.
Also, what's interesting too is that I wonder if you could see some real rotation in the market, but without tech, the overall index is going to be weak.
That's
for the
exactly
S&P.
it.
But like utilities can still do well. For example, healthcare can still do well. It's just not going to support the broader.
And those sectors that you're highlighting, if we do go into something that is corrective, like NVIDIA, I think NVIDIA is now down about 35% from its recent high. If the overall indexes were to do something, those are exactly those defensive sectors that offer dividends would be the sectors that people would crowd into: utilities, healthcare, and the like.
All right, Abigail, thank you so much for joining us. Abigail Doolittle, she covers all the markets for Bloomberg. We appreciate getting a few minutes of her time. Let's go back to this jobs report, because Abigail suggested that's a big part of what's driving the sell-off in today's market. We welcome Christopher Smart. He's a managing partner in Arbroath Group. He's a former special assistant to the president for international economics. He joins us from Boston, Massachusetts. And if you're listening to us up in Boston, our new home is now 92.9 FM in Boston. Christopher, how do you think the folks down in D.C. that really think about this economy, worry about this economy, try to manage this economy, how do you think the folks down in D.C. are taking this labor data we saw today?
Well, first of all, welcome to 92.9 in Boston. We're all very excited to have you.
Thank you for the plug.
On a new channel. In terms of what they're doing down in Washington, I'm afraid they're probably spending a lot more time thinking about the election implications of all of this. I'll just pause and not answer your question right away. I think it is quite remarkable that we are talking about a Fed cut of 25 or 50 basis points 2 months out of election. And most of the market and most of the nonpartisan analysis would be that this is totally unrelated to any political calculation on the part of the Fed or the Biden administration. So I think that's kind of a nice plug for Fed independence. In terms of the jobs report, there was something for everybody, I think, in this report. For the hawks, there was, the unemployment rate notched down a little bit, hourly earnings were up a little bit, and so that would give them fuel to argue for 25 basis points. For the doves, we still have a miss in terms of the headline jobs growth number, and we have downward revisions of the past couple of months. So I think, as I say, there's plenty to fuel both sides of the debate. My bias would still be that we're going to see 50 basis points because of the other data that we've seen accumulating, and because, as long as they are able to signal maybe as a hawkish cut, that this is not, we're not going to get 3 50 basis point cuts for the next 3 meetings. We're going to do 50 now and then wait and see till the end of the year.
You're right. So it's not like they're overdoing it. They're like, okay, we'll go now, but then let's just see. What in the economic data tells you that we need 50? Because the other part of the argument is like, look, if you go 50, you're saying things are a lot worse than you might have thought.
Well, to me, maybe to argue with your previous guest, that inflation is really not the problem anymore. It is a problem politically. It is a problem for consumers. It's a problem for lower income households. But the numbers are coming down. If you're in the monetary policy business, you see that you're pivoting from fighting inflation now to boosting growth. And I think they have plenty of room to move from current levels down to something a little bit easier, if not, it's certainly going to be still in the tight range. The economy is slowing in the U.S. There's much more slowing going on in Europe. China is obviously stuck right now. So I don't see the risks to inflation right now. And I really think, as you see, those are big headlines coming out of Governor Wallace's speech. If that's the broader message he intends to deliver, I think that's going to increasingly turn markets towards expecting 50 next time.
Chris, you mentioned kind of the timing here. We're in an election year, and it looks like this Federal Reserve is going to be pretty active in terms of making some policy changes right around this election. How uncomfortable do you think that makes the Fed?
I think it makes them very uncomfortable. I mean, Jay Powell's been asked about this through a couple of different meetings. He's been very forceful and I think very credible at saying, look, we don't, you can read our minutes, we don't talk about this. We don't talk about the election. We don't talk about any of that. We look at the data. It's hard enough getting the data right. And it's hard enough setting monetary policy for this dual mandate, let alone taking other election implications into view. So I think it is notable that they feel free to do it now. I think they don't love the fact that they have to do it now, but they, I think, feel that this is the right time. The data is pointing in that direction. Markets are expecting it, and that they can move ahead. I don't think they'll get any more, cuts in October or anything like that. But they'll pick up after the election and see where the data guides them.
You were also a former special assistant to the president for international economics back in your previous life from 2013 to 2015. We've been getting a lot of information about economic plans, particularly when it comes around corporate taxes. And I'm wondering if you've been able to think about or model out the different outcomes on corporate tax policy. Like, clearly, yes, lower corporate taxes will be good for the S&P, but in terms of, say, reinvestment and economic growth.
Well, the devil is always in the details. President Trump's proposal is eye-catching in terms of a dramatic cut in the headline rate, but that seems to be linked with manufacturing things in the United States. And I think he talks about, 100% manufacturing in the United States. Very little, as you know, is 100% manufactured in the United States, given the inputs to manufactured goods that come from many, many other countries. Sometimes, I think they say that if you buy a car in the U.S., there are parts that have crossed the Mexican border 5 or 6 times before it reaches the dealer's lot. I would guess what markets are expecting is that, corporate rates are probably not likely to move much more from where they are right now. Vice President Harris is in line with the Biden proposal to raise them to 28%. President Trump is talking about 15%. We have this thing called Congress, which is a big toss-up, and more likely than not, it may move 1 or 2 percentage points up or down, but it's not going to be a significant shift, I don't think.
So, Chris, to what extent are you, your team, folks in Washington, D.C., are they talking about, annual deficits? I mean, and annual deficits, the national debt. Is this something that gets any serious conversation?
Yeah, I mean, I'm sorry, deficit?
Yeah.
Yeah, totally.
I think people like us do talk about it. People in the markets do worry about it. But if you are a politician and you're looking at the next election, why should I worry about this thing that's going out 10, 20, 30 years when I've got to win in November?
Yep.
So, and you're telling me that credit markets are going to punish me for bad behavior? Well, when? I haven't seen it yet. And, why take on that thorny issue now when I don't have to?
Well, this is what gets confusing, I think, about the trade deficit, too, to that point. Don't we need the trade deficit because we need foreign investors and countries to buy our debt? So if we close the trade deficit, there's less money for them to do that. And that's where I think I get a little confused on all of it.
Well, you're not at all confused. I mean, you're absolutely right that those things are intimately related, and nobody likes to talk about that. I think the focus on the trade deficit raises a lot more issues around our savings rate, our investment incentives, and that sort of thing. Rather, the proposals that we tend to go to easily as policymakers and politicians, which are tariffs, generally don't tend to do much to redress those differences in trade deficits that people want to, because we are so interlinked in so many ways with our foreign markets and with other foreign markets. A bilateral trade deficit gets a lot of attention between the U.S. and China, but really it's really the overall balance of trade that we have with all of our trading partners that will matter.
All right, Christopher, thank you so much. We appreciate that. Dr. Christopher Smart, he's managing partner at Arbroath Group and a former special assistant to the president for international economics. I Googled what Arbroath is. Apparently, it's a burg in Scotland.
Oh, okay.
So there you go.
All right.
He's up there in Boston. If you're listening to us in Boston, our new home in Boston is now 92.9 FM. In Boston, it is a big stick, and it gets a big coverage of New England, so that's good for our New England folks. It's Friday. You know what that means.
Munis.
Munis in focus. Shruti Singh, Bloomberg News municipal finance reporter. She's going to join us to discuss the latest in the municipal bond market. Looking at the bond yields, 10-year Treasury off 7 basis points. 3.65% is the yield. Well, more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the morning right now for the U.S. stock market. Federal Reserve Governor Christopher Waller says it is important for the central bank to begin cutting rates this month amid rising risks of further weakening in the labor market. Stocks getting hit by a tech sell-off, bonds whipsawing after the latest jobs report left traders wondering whether the Federal Reserve will deploy a supersized rate cut in September. S&P S&P down 80, drop there of 1.5%. We have got the Dow down 332, down 0.8%. NASDAQ now tumbling by 382 points, down 2.2%. 10-year at 3.66% with a 2-year 3.64%. Gold down 0.1%, 25.13 the ounce, and West Texas Intermediate crude down 1.5%, 68.14 a barrel on WTI. Jobs Friday, reaction to the jobs report from Christopher Smart of Arbarth Group, who was interviewed moments ago right here on Bloomberg Intelligence.
There was something for everybody, I think, in this report. For the hawks, there was, the unemployment rate notched down a little bit, hourly earnings were up a little bit, and so that would give them fuel to argue for 25 basis points. For the doves, we still have a miss in terms of the headline jobs growth number, and we have downward revisions of the past couple of months.
Christopher Smart of Arbarth Group, and you can hear more of the conversation on the Intelligence Podcast. You can download it wherever you get your podcasts. Boeing seeking to avert a crippling strike by its largest union. As the clock runs out on the existing accord, rank-and-file workers will be voting twice on September 12th. And JetBlue shares are gaining. Vladimir Galkin, a little-known Florida-based investor who amassed a substantial stake in JetBlue Airways in recent months, has been meeting with the carrier's top executive to discuss a possible board seat. Recapping, stocks lower, S&P down 1.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by Build America Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provide guaranteed income to improve any portfolio. Be a part of Building America. Invest in BAM.
BAM.
Insured bonds. There you go. Shruti Singh joins us. She is municipal finance reporter for Bloomberg News. She joins us via Zoom from Chicago. Shruti, earlier this week, Tuesday and Wednesday, we had north of 30 companies tap at the corporate bond market. Just an explosion. I think Tuesday was the biggest day ever. Talk to us about debt sales in the municipal bond market. Are you seeing similar type levels of issuance?
Well, this whole year has been really busy for municipal issuance. Partly it's because there's been a lot of pent-up demand. State and local governments have projects that they want to get underway. They're also sort of winding down on the federal aid that came about after the pandemic or during the course of the pandemic. And so right now there's been a lot of pent-up demand for financing. And the other thing that's been happening is that they are trying to come to market before any volatility might come about because of the November election.
So does that wind up implying that the volatility we wind up seeing in the equity market and the overall bond market doesn't translate to the muni market?
So the muni market generally tracks the treasuries market fairly closely. And so that's a benchmark that most municipal investors, analysts, issuers usually track.
So talk to us about just how the performance is. How are the municipal bond market, how's it performing this year? How are returns?
Yeah, so I think returns so far have, they had a couple of years when things were a little bit rough, but I think this year returns so far for the overall municipal bond index are up about 1.65% or so. So not bad, but I think that there's a lot of questions still. Last year, for example, we saw most of the returns coming in the fourth quarter of the year, so there's still time to see what's going on for the rest of the year, especially given we've got some major items coming up in terms of, what the Fed's going to do, what's going to happen in the election. So let's see what happens in the fourth quarter.
What kind of cool issuance stuff have we seen? Like, where are we seeing maybe the most issuance? What kind of projects?
For example, I'm here in Illinois and Chicago, and one of the large deals we're expecting is next week from the state of Illinois. It's a refunding deal, but there's also some water money coming, bonds being sold in Chicago. So there's a lot of infrastructure. And earlier in the year, we've also seen a pickup in airport infrastructure deals as well.
Your colleague, Amanda Albright, is out with a really interesting story this week about mega deals in the municipal bond market. Number of municipal bond deals over $1 billion in 2024 is by far the busiest year, close to 40 deals north of $1 billion. What's driving that?
I mean, I think it tracks the general increase we've seen in issuance overall. Right now, issuance so far this year is about 38 to 39% higher than the same period a year ago. And, you know, and there's also, like I said, there's a little bit of a rush to come to market before the election. And so, because there's so many unknowns with the election, right? And so I think part of it is that. But as I also mentioned, there is pent-up demand. If you just look at infrastructure, you know, there's always so much talk in the U.S. about the need to update roads, bridges, and all kinds of other infrastructure. So, but the last couple of years, they had some money coming in through the federal government. So maybe there wasn't as much need for that. So a confluence of events is happening right now.
When it comes to the election, and I feel like it's a tax thing, what is the big risk? I understand the volatility, but also are we worried about proposal changes from either a Harris or a Trump administration?
Well, but it's not the only factor, right? So one of the things that everybody's watching, including in the muni market, is what the Fed is going to do next, right? So you've got multiple factors that are going on, but we don't know exactly who's going to win and what the Congress is going to look like. So regardless of who the president is, the makeup of the Congress is also going to determine what proposals from either candidate actually are enacted, right? So there's a lot of different questions out there about that.
Credit quality. Well, actually, let's go to the taxable municipal bond market. How's that performing? Because that's been a growing part of the overall municipal market.
You know, as far as I know,
wait, they're taxable. I thought the whole point with munis is that they weren't
exactly.
taxed.
All right, so let's
this
start
is Paul's
there.
point.
Shruti, why is there a taxable municipal bond market? What I thought one of the primary reasons to buy a municipal bond because it was triple tax free.
I mean, if you look at the large part of the municipal bond market is tax exempt, but there are corners of the market that are taxable. And the market, as far as I know, is not as large as it was previously for taxable. And a few years ago, there was a big increase in advanced refundings, and but the rates are different now. So that is a factor in changing the makeup of how much of the market now has shifted to tax exempt. But, you know, I haven't looked specifically at the performance comparing tax exempt versus taxable.
I'm very happy with my municipal bond portfolio, my nicely laddered municipal bond portfolio, which has been so good to me since really 2000. Shruti Singh, municipal finance reporter for Bloomberg News, joining us via Zoom from Chicago. Michael McKee darkens the door here. He covers all the economic stuff for Bloomberg Television. Mike, I guess we got the jobs print today. You know, we had Mark Zandi and Claudia Sahm on simultaneously, kind of a little joint interview with Tom Keene and myself. Mark Zandi said, the labor market's fine. And Claudia's, 4.2%, that's okay. Still adding jobs, that's okay. Were the revisions down? Yeah, it's okay. It's normal. Claudia's like, no. The recent trends are really what you have to be concerned about. What was your takeaway from the print today?
Right in the middle, which is what I said when the number came out, that this is going to be really confusing to people because it doesn't give us a firm answer either way. You look at the unemployment numbers and the underlying reasons why unemployment went down this month were good reasons. We've had a smaller labor force gain, and we had a larger gain in jobs than and we lost. The number of unemployed went down, so that's good news. But the rate at which we are adding jobs has slowed. There was a big revision, and we know that we're going to get revisions. It may not be the 818,000, but we will get revisions to prior months that could push some down significantly. So it just depends on what you're looking at.
Well, what about Waller, though? I feel like when Waller came out and said that the current batch of data requires action, that feels more like we got to go, and we got to go 50.
Well, he probably had prepared two different speeches, but I think that would have been in there either way. I think he was prepared to say it was time to cut rates. I don't think he meant that today's data were the definitive reason to cut rates. What I found interesting was that he did throw in the idea that he'd be open to front-loading rate cuts if the data suggested it.
Right.
But I don't know what data we're going to get really between now and the Fed meeting.
Yep.
because the inflation numbers, CPI inflation numbers aren't going to influence it. So I don't know what we get that he couldn't have made a definitive answer then. So it's hard to know what the Fed is going to do with this, and the markets can't quite figure it out either. I was just looking at the daily market tracking for the September Fed funds expectations, and for the yield curve, 210 yield curve, and it looks like somebody had a heart attack. They just up and down on the screen, depending on it first was the data, then it was Williams, now it's Waller, and I think it's going to be a while till people sort this out. It's going to be a really interesting question for people in the markets is how do you leave on Friday? You know, do you leave set up?
I'm like, through the door. What's the problem? No, fair enough.
I mean, our favorite bond, or my favorite bond nerd, Lisa Brahma, she was out with a tweet kind of showing that chart, kind of where the 210s were. But